Hi everyone, hope you all must be doing great. So today we are starting with a very interesting topic, transfer pricing. We'll be doing, I would not say a quick revision, I would say rather a thorough revision of this chapter. Quite important from examination perspective. Every time we see that around 6 to 8 marks, sometimes it can go as high as 10 marks also. So every time we see that this transfer pricing chapter, the question from this chapter is asked in your examination, and students make some silly, I would say some silly mistakes. Generally 50% are the chances that the question will come that how to compute ALP by any of the methods, and students find it very confusing. Sir, there are so many items related to, there could be adjustments related to warranty, related to credit period we have given, related to brand of the associated enterprises, and whether we have to add that item or we have to subtract that item, and the students generally make mistakes in that. I'm telling you, it is very easy. Today we'll be discussing all that. So my target for today is that obviously we'll be discussing these computation of ALP, but we'll be touching the entire chapter conceptually. Also we would be doing, and wherever required I will actually support it with the questions also, especially those questions which have were there in your past examinations. And since it is not a regular batch, it's a revision batch, so still I might go a little fast at some places, but still I would make sure that I will not be rushing at any of the topic, right? So after this discussion might go for, let's say, around 3, or let's say little bit more than 3 hours also. So it doesn't matter, guys. The only requirement is that you should understand each and every concept of transfer pricing, which is a very easy and interesting chapter of CA final direct access. Okay, so let us start with this. And I want this interaction to be should not be one way. I want your support as well. So whatever the book which you have, you can open that book from wherever you are, actually you have done your transfer pricing or you have not yet done it. Doesn't matter, guys. There is also, I'll also be sharing the notes of this of the entire chapter. You can find the link in the description itself. And I'm telling you, these notes, this book is actually very meticulously prepared by me with a lot of efforts. On every page, I have spent tremendous amount of time so that it could be comprehensive also. I should cover each and every section, each and every provision as well, and that too very interesting way in a short span of time, so that you can do multiple revision. In fact, one day before the examination also, if you would like to read it, you will be able to read it in a short span of time. So this can be downloaded from our from our application. So the link would be in the description. You can go to the free download section and you can download this notes as well, right? Very, very fantastically, superbly prepared, I'm telling you. Okay. What I have done is actually the chapter is starting from this page number 2, but in on page number 1, what we have done is a snapshot of the entire chapter, so that we should connect that what are we doing and what are we supposed to cover yet. So in fact, this first page you will find it very, very helpful. Once you are thorough with your entire chapter, then you can relate it. You will be, what I have done is I have made a separate segment, separate boxes for each particular topic, so that you should know that what are we doing actually. Like the first is very basic, that what is section 92, 92A, 92B and 92BA. So that is associated enterprises, international transaction, definition of specified domestic transactions. Second box is related to computation of ALP. Third box is whenever this ALP is determined by assessing officer, what is the effect of that? That is again a very important question from exams. How the ALP is determined by TPO. Then the next box is about advanced pricing agreement and so on, right? Penalties, everything I have covered, secondary, primary adjustments, everything I have covered over here. So let us jump into the chapter. I'm repeating, I want it to be very interactive. So whatever the book you have, you can please open it, and wherever I would request you to write something or to solve question with me, please do that with me. Correct. So with this, let us start with the chapter. See, there are few basic sections which we should know, not necessarily the section number, but we should know about them, that what are these. See, there are first three, or I would rather say four sections which are very, very basic, which you should know. First is section 92. What it is all about, I'll tell you. So one is section 92, you should know. Then second is 92A, 92B, and 92C. Although one more section in between, which is 92BA. What are these sections all about? See, section 92 is actually the charging section. We call it generally charging section of transfer pricing, that why transfer pricing or when will transfer pricing will provisions will apply. See, transfer pricing provisions came. I believe that you all know what is transfer pricing. Okay, I'll give a little minute also on that. See, transfer pricing provisions came into India in the year 2001. You don't have to remember for your examination, but just for your reference. So transfer pricing provision came in this year. Why? Because there was a need to it. Because Indian tax, if I just talk about related to Indian context, Indian government was losing on their taxes. So that is the reason they came out in 2001. They came out with the transfer pricing provision. Before that, there was no transfer pricing provision. And in fact, after 11, 12 years, in the year 2012, first they brought they brought transfer pricing provision with respect to international transaction, right? But later in 2012, they have expanded the scope of this transfer pricing to some domestic transactions also, which we call them specified domestic transactions. So specified domestic transactions, I'll be talking about that after half an hour or so. So right now, in the first half an hour or 45 minutes, my discussion would be more related to international transaction. Otherwise, specified domestic transaction is also very easy. That is covered in this particular section. 92BA deals with specified domestic transactions. So what are this? Why we have covered specified domestic transactions also, that I'll be covering today. Okay. So in 2001, the government of India came out with Indian tax law, came out with the international taxation. Why they came out? Because actually, the Indian government was losing on their taxes. How? Let's say there is some MNC which is operating in different countries, and they have their business in India also. Let me take the example of Pepsi, right? So let's say this is a company, Pepsi Incorporation. Let's say this company is the parent company situated in US, and they have, let's say, companies, they have businesses in other countries also. Let's say, for example, in India, they have Pepsi India, right? In other countries, they have, let's say, for example, they have Pepsi Mauritius also, right? So what was happening is that there are certain transactions which are happening between these countries, and especially let us take this into center position. So let's say these transactions are happening between these countries, and the transactions were not happening at the correct value. It was not happening at the correct value. See, if the transaction would be happening at the correct value, then everybody's okay. That whatever is happening is nothing. There is no tax evasion. Everything is happening is good enough. So we are not concerned. But the problem here is that if the transaction is not happening at the correct value, and because of that, the country is losing their taxes. Specifically, India is losing the taxes. How? Let's say, for example, there is a transaction which is happening between Pepsi India and Pepsi Mauritius. And we understand the tax rates are different, especially Mauritius is a tax haven. There is no tax rate or a very less tax rate. So let us assume that in Mauritius, there is a very, very less tax rate, but India, compared to it, the Indian tax rates are a little bit higher. So you can understand that, let's say, for example, there is Pepsi India Limited. So they have a tax rate of 30%, right? But in Mauritius, the tax rate is very, very low as, let's say, 5%, 10%. So what was happening is, let's say, for example, if Pepsi Mauritius is doing a transaction with Pepsi India, let's say, for example, it's a transaction of sale, right? So let me make a P&L account for Pepsi India. So let's say Pepsi India is actually, they are making a transaction of sale. So Pepsi Mauritius is making a transaction for sale. So for us, actually, it is a purchase transaction, correct? For Mauritius, it was sale. So for India, it is purchase. So what they were doing it, they were not doing it at a correct value. They are actually selling it at a higher value. For example, the correct price of a particular transaction should be, let's say, 10 crores. But what they were doing is they were actually transferring it as 50 crores. Why? See, what will happen if they will transfer at 50 crore? So in India, the correct value should be 10. But it was what we were doing it. They were recording, the Indian enterprise was recording it at 50 crore. And if we will increase our expenses, it should be 10. But we have recorded it at 50. So if we will increase our expenses, obviously our profit will decline. And if our profit will decline, our Nirmala auntie will receive very less tax. Indian government will receive very, very less tax. So that is the reason this was not happening at the correct value. And sir, why they are doing it at a higher value? See, in Mauritius, they are not concerned. Let's say, for example, there is zero tax. So let's say if they are doing it at 50 crore, 100 crore, 200 crore, for them, let's say it's a zero tax. So for them, there is no issues, right? But what they were doing is they were actually saving tax, so much of tax they are actually saving in India. Same way, for example, Pepsi India, let's say if selling something, for example, they are selling something, right? So let's say this is an income transaction. So if they are selling something by sale, actually the correct value should be 100 crores. The correct value should be 100 crores. But they were saying that India, whenever you will actually make a sale transaction, please make it at a lesser value. Let's say, please record it at just 40 crores. See again, if they will record it at a 40 crore, which is not a correct price, then the income side is just having 40 instead of 100. Again, our profit will decline. So that is the reason before 2001, it was happening so much. But in 2001, they introduced with the concept of transfer pricing. They say that if there is any transaction which is happening, any international transaction, specified domestic transaction came in 2012, right? So let me talk about international transaction. So if any international transaction is happening, it should be at the correct value. It should be at the correct value. And we call this correct value in transfer pricing. What do we call, guys? Everybody knows it. What do we call it? It should be at arm's length price. It should be at arm's length price. ALP. So now, from now onwards, I'll be using this term ALP. So it should be at ALP. ALP means a fair price, a correct price. Why? Because if what they will do, so they will say that no, this 40 crore is not a correct value. We will change it. We will change it to 100 crore. You should record it at the correct value. And this purchase which you are showing at 50 crore, no, the correct value, let's say, is 10 crore. So you have to record this at 10 crore only. You have to show this at 10 crore only, and we will actually take the correct taxes from you. So that is the reason transfer pricing provisions came in India. So earlier, when in 2001, when it came, so it was written that any income arising from the international transaction. So people have misinterpreted it. They were saying that, only income, expenses are not covered under transfer pricing. Then what lawmakers did it? They inserted an explanation in section 92. So this, what I am talking about is, guys, the first section of transfer pricing, section 92. Are you all understanding till now? So section 92 is the first section for transfer pricing. It says that if there is any income which is arising from an international transaction, any income which is arising from an international transaction, we should actually give regard to, it should be recorded at, it should be done at arm's length price. Got it? So this was section 92. Then people have misunderstood it. They were saying that, only income should be treated at arm's length price. What about expenses? So we will not consider expenses at arm's length price. They said no. They have inserted an explanation in this section that no, not only income, guys, not only income, but your expenses also. Your any type of expenses. Let's say if you have taken a loan, from outside, right? So the rate of interest which you are paying should be at the arm's length price. It should not be inflated. Please don't inflate your expenses. So please tell me, is it only income or expenses should also be considered at arm's length price? expenses should also be considered at arm's length price. Correct. Second, guys, even if there is a allocation of expenses, what is allocation of expenses means? Let's say, for example, there are, let's say for simplicity, I'm taking three companies: Pepsi US, Pepsi India, and Pepsi Mauritius. Three companies. Let's say, for example, Pepsi US has incurred an expenditure, a common expenditure for all of them. For all of them, they have incurred a common expenditure. Let's say, for example, they have incurred a common expenditure of, in rupees terms, I'm taking, let's say, 100 crores. So what they were doing is they were allocating this expenses between these companies, between these countries, that for this country we have done this expense, this country we have done this expense. So they were attributing, they were allocating this expenses. So what they used to do is that out of 100 crore expenses they have done, they were saying, okay, 20 crore is for US, 10 crore is for Mauritius, and 70 crore is for India. See, again, what they were doing is in India, they were inflating the expenses. So we should say that no, even if there is allocation of expenses, it should be done at a correct price, at arm's length price. So this is known as allocation of expenses, right? So this is section 92. So if you will see in your book, let me come to this page, second page. See, section 92. I'm telling you, this book is very beautifully prepared. You will download it, you will realize it. Okay. Section 92, computation of income from international transactions and also specified domestic transactions. Specified domestic transaction I'll take after some time. So it says any income arising from international transactions shall be computed with regard to arm's length price. It should be computed with regard to arm's length price. Now here it is written income. Only income? No. The explanation was inserted. Not only income, boss, the expenditure also. All expenditure, your interest, any type of expenditure. It could be purchases also. It could be, let's say, if you are paying royalty to your, it's an international transaction, you are paying it to the associated enterprises, or you are actually incurring for know-how or any expenses which you are incurring, it should be the arm's length price. Even the allocation of or apportionment of expenses. You understand now? Allocation of expenses, that should also be at the arm's length price. That should also be determined at the arm's length price. Are you okay with this? So I was telling you, let's see. I was telling you can write it also somewhere that section 92, that is a charging section for transfer pricing, that when will transfer pricing provisions will be applicable. So that is the charging section. So when it will be applicable, whenever there is an international transaction or specified domestic transaction that I'll talk about. Then what is an international transaction? Now the question is that what is an international transaction? So if, let's say, for example, you have a business in India, and you are actually selling something in Germany. Let's say there is a company ABC Private Limited India, and you are selling something to Germany. Let's say, for example, you are selling something. Let's say this is ZINC in Germany. So is it an international transaction? Yes, it's a cross-border transaction. You are actually exporting it. So the answer is all international. This is, I can say, a layman will say that yes, this transaction is happening between two countries, so it is an international transaction. There is no international transaction has been defined in section 92B. 92B says that what is an international transaction? It says that transaction which is happening between associated enterprises only. And what is associated enterprises? 92A. See, A for associate, right? You can learn like this. So A for associated enterprises. So if any transaction is happening between associated enterprises, why? See, because if you are in India and you are selling something in Germany, and let's say, for example, this person is not related to you, do you think that you will actually sell something at a lesser value? No. Obviously, if a person is not related to you, you will sell it, any transaction which you will do with them, you will do at a fair market value, right? Today market is very competitive. You will do at a market value, correct? So from strangers, you will not manipulate it. So you can only do these manipulations only when you are actually part of one group. You are associated with each other somehow. You are closely associated with each other. Then only you can do these manipulations. So what is international transaction? So is it an international transaction? A layman will say India and Germany, international. No, please understand that India and Germany, it should be associated enterprises. Now, what is an associated enterprises? That is written in section 92A. So these section I was telling you that you should remember that 92 is a charging section. It's a simple section, but this 92A, in fact, is if among these three, I would say this is the most important from examination perspective. Many times, if you will pick up last 10 attempts paper, you will find that 40%, 40 to 50% questions are coming from this also. Actually, it's a mixture of 92A and 92C is computation of ALP. See, C for computation, determination of ALP or computation of ALP, or how you will determine your ALP. That is 92C. 92B is the definition of international transaction. Right. So again, I'm repeating. What is 92? Please write these four sections. 92 is the charging section, that whenever there is an international transaction which is happening. What is an international transaction? It is defined in section 92B that whenever you will do the transaction between the associated enterprises. So international transaction between associated enterprises, not with any other, not with any stranger. Now, who is associated? That is defined in this section 92A, that who are associated. Right. Okay, let me tell you something about 92B. See, please tell me, we are defining international transaction. So please tell me if any transaction is happening between two residents. This person is also resident of India. Another person is also, let's say, buyer and seller, they both are resident of India. Do you think it's an international transaction? No, it is not an international transaction, right? It's a domestic transaction. Sir, you were saying that domestic transactions are also covered under this transfer pricing provisions. I'll tell you about that. But obviously, this is not an international transaction. If the transaction is happening between two resident, we will say no, it is not an international transaction. If a transaction, this section 92B, it's very easy, guys. You don't have to learn it. The definition is such sweet definition. It is saying that an international transaction should be that transaction where at least one party should be a non-resident. What does it mean? That this transaction should be like this, that one party, this is a resident, so the other party should be a non-resident. At least one party should be a non-resident. That is an international transaction. So will you say this as an international transaction? The answer is yes. We will say this as an international transaction. Okay, tell me, let's say if there are both, because the definition says at least one party. So please tell me, this one is a non-resident, the other person is also non-resident. Is this transaction also an international transaction? So if you will read the section, if you will read the provision literally, it says that at least one party should be NR. So yes, in fact, both the parties are NR. So this should be an international transaction. But please guys, apply your brain, right? So what you will see that, please tell me if a transaction is happening between US and UK. So there is a person who is sitting in US, there is a person who is sitting in UK, and they are having a transaction with each other, any transaction with each other. So do you think that India will jump into it and they will tax this transaction? No. US person is saying that why India is coming. So India has become a superpower. They will tax every transaction. No. So US will say if the transaction is happening between US and between a person in UK, this person is sitting in London somewhere, this person is sitting in, let's say, New York somewhere. So why they will pay tax in India? So if they will pay tax in India, then Pakistan government will also come. Sri Lanka government will also come. That all these Asian countries are coming to tax it. No, we can't tax it. But sir, but the definition says at least one should be NR. Yes, at least one should be NR. So if this transaction is happening between the two, but if any of them are related with India, how? Let's say any of such income is taxable in India, then India, it will be an international transaction. How it will happen, I'll tell you. So if this is a transaction happening between two non-resident, but one of the non-resident is liable to pay tax in India. If one of the non-resident is liable to pay tax in India, then this is also an international transaction. Understood? So what is an international transaction? between between two residents, no, not at all. That is not an international transaction. It should be at least one non-resident. So obviously this one, obviously 100% covered. This would be covered if at least one NR income is liable to tax in India, then it will be covered, right? Plus it should be with associated enterprises. This is what international transaction is. So this should be with associated enterprises. This is called an international transaction, section 92B. There is one more thing, deemed international transaction. I'll tell you about deemed international transaction after 15 minutes. So if you will see, give me a moment. See, this is on page number 15.3. What is an international transaction? International transaction means a transaction between two or more associated enterprises. So to make it international transaction, now a layman will say that any transaction which is happening between India and Germany, India and China is an international transaction. No, as per the law, it should be between associated enterprises. And at least one of them must be a non-resident. So either this transaction between resident and non-resident, okay, but it should be both non-resident also. But if they both are non-resident parties, then India becomes a superpower. No, we will only tax it, this transaction, we will only apply transfer pricing provisions if at least, if both the parties are non-resident, then transfer pricing provision will only apply if at least one has taxable income in India. Understood? So this is an international transaction, important thing. So there is something known as, and this transaction can be of anything, right? It can be of sale, it can be of purchase, it can be of paying your interest, it can be paying your royalty, it can be allocation of your expenses. So this transaction can be of anything. It can be any, you are providing any services, it could be lending, borrowing, allocation of any cost or expenses. It can be a transaction in the nature of business restructuring, amalgamation transaction is happening, demerger transaction is happening. So this transaction can be of any type. Got it? Now, what is a deemed international transaction? I'll come to it after 10-15 minutes. So half of 92B we have done. See what we were doing. I was telling you that these sections you should know. 92, what is 92? Try to recall this. 92 is charging section. It was saying that if there is any international transaction is happening, we will see that whether it is at ALP or not. What is ALP? Correct value, fair market value, right? 92B is international transaction. 92 international transaction is says that any transaction where at least one should be a non-resident between associated enterprises. Now we are coming to a very, very important section, that is 92A. What is an associated enterprises? Okay. See, just first understand, we will come to the definition, but first understand that what is associated. Associated means that two enterprises are closely connected with each other. Why they are connected? Might be the one enterprise might be holding the equity. Let's say if you hold a equity of another enterprises, right? If you hold a equity, a substantial amount of equity, if you hold, then you will become a associated enterprises. This is the one parameter. Second is, let's say if you control the management, one enterprise control the management of another enterprises, then also they become associated with each other. So either you control the equity of that transaction of that particular enterprise, or you control the management of that enterprise, then you become an associated. Or there might be some other parameters also, which is not actually visible on the face of it, but actually you have a control, which is actually a little bit hidden control. So if you have a hidden control, which we cannot see literally, prima facie we cannot see, but actually you have applied some hidden control, then also you will become an associated enterprises. So you will see, guys, when I'll be discussing this section now, 92A, associated enterprises, you will see that either whatever is written in this section 92A, that either you are holding a substantial amount of equity of the other enterprise, or you're controlling the management of the other enterprise, or there is some hidden control which we are not able to see, but yes, there might be some hidden control, then also you will become an associated enterprises. Very, very important section. You should know it. Question comes on in exams. Question comes on this particular section also. 92A. See, guys, are you all able to understand now? Okay. You can like the video also. Please do like the video so that it can reach other students as well. Section 92A, Associated Enterprises. So this is on page number, guys, second page. This is 15.2. So what is an associated enterprises? It says two enterprises shall be deemed to be associated enterprises if at any time during the previous year, one enterprise holds directly or indirectly shares not carrying less than 26% of the voting power in other enterprises. What is voting power? Equity shares. If you at least hold 26%, guys, if you hold 25%, no. But if you hold 26%, share of another company, then you become an associated enterprises. Let's say, for example, there is let's say India Limited. It's in India, and let's say US Limited. It's in US. So if US Limited is holding at least 26% shares, 26% shares US Limited is holding of India, then they both become associated enterprises. Okay, guys, it is not just one way, it can be both ways also. So whether US Limited is holding 26% or I Limited is holding 26% also, then also it will become associated enterprise, right? It's not only that always foreigners will hold Indian companies. No, Indian company can also hold foreign company, right? So whether Indian company is also holding 26% or more in US Limited, anyone. So both ways are correct. So they both will become associated enterprises. And if any transaction which is happening between these two, any transaction which is happening between these two, whether it is a purchase transaction, whether it is an expense transaction, whether it is allocation of cost, whether it is an income transaction, it should happen at ALP. It should happen at ALP. This is what we are talking of, right? Okay. Please tell me, let's say, for example, let's say this is our previous year, 25-26. Let's say on 1/4/2025, let's say I Limited, India, I for India, right? So let's say I Limited is, and U Limited. U Limited is for US. U Limited is holding, let's say, 2% shares, 2% equity shares of I Limited. Is it they are associated? The answer is no. They are just holding 2%. Okay. Let's say on this date, on 1/4/2025, on this date, there is some international transaction there is some transaction which is happening. There's some transaction which is happening on this particular date, let's say of rupees 100 crores between these two. Guys, will you apply transfer pricing provision on this? The answer is no. You will not apply transfer pricing provision. Why? Because they are not associated. Let's say after some time, let's say during this year, after some time, no other transaction has taken place between these two at any other in this year. Let's say on 15th March 2026, U Limited has also purchased, let's say, 30% shares more in this company. Correct. They have purchased at the end of the year, somehow they have purchased 30% shares of this company. Now, obviously, they become associated, right? Whether you, because from 15th March 2026, they become associated. Now, please tell me whether you will apply transfer pricing provision on this transaction or not, because this transaction has happened in past. When on this date, this company is holding just 2%. So whether you will apply TP provisions here or not, please tell me, guys, please tell me in the comment that whether you will apply TP provisions here or not. The answer is yes, you will apply. Yes, you will apply. Sir, on this date, they were not associated. Doesn't matter, guys. You have not read this definition carefully. So it's written, two enterprises shall be section 9. Which section we are doing? Section 92A. A for associated, A for not Apple, A for associated enterprises. So 92A is telling you two enterprises shall be deemed to be associated if at any time during the previous year, see, I have highlighted this in the book itself. If at any time during the previous year, so it doesn't matter that when the transaction is happening between the two, you were associated at that point of time, doesn't matter. At any time during the previous year, if you were holding more than 26% or more, then you will become an associate enterprises. Guys, why it is 26%? See, because the Indian enterprise might be having, let's say, for example, this is has 26%. So they might be having only 74%. They will not be able to pass the special resolution. So if they will not be independently would not be able to pass the special resolution, it means that you limited is controlling them, right? So this is 26% and all. Okay. Second is, so this is the first one. Second is that if, let's say, A Limited, A Limited is holding 26% or more in B Limited, and they are also holding 26% or more in C Limited, right? A is holding, but B and C, they are not holding equity of one another. So obviously A and B would be associated. Yes, obviously A is holding more than 26% or more. A and C is also directly by point number one, they would be holding. But point number two is saying that if you are commonly held by one person, so B Limited and C Limited, you both will also be associated enterprises. And guys, what is the implication if you will become associated enterprises? TP provisions, ALP. Correct? So now, if any transaction is happening between B and C, then also we will apply transfer pricing provision. It is an international transaction as per section 92B and as per 92A. I'm specifically using these sections so that it can hit in your mind, right? And 92A should is telling you that you will also become an associated enterprises, right? So any person or enterprise holds directly or indirectly shares carrying not less than 26% of the voting power in each of the enterprises. So I've written it over here. A is holding in B. Obviously, A and B are associated. A is also holding in C. A and C are associated, but B and C also become associated, right? So see, I was telling you now that why you become associated enterprises. Why? Because mainly three reasons. Either equity. So when you are actually now right now you are doing 92A, so you can appreciate that why we are making it associated enterprises, because of equity control. Okay, let us see management control also. See, if, let's say, again, I Limited, U Limited, guys, I for India, U for US, correct? So I Limited Indian company, U Limited US company. Let's say, for example, they are not holding equity, but U Limited has, for example, I Limited has board of directors. It has board of directors. Let's say 20 board of directors it has, right? And if U Limited has appointed more than half, if U Limited has appointed more than, not exactly half, not exactly 10, guys. Students make a mistake over here. Not exactly 10. It should be more than 10, more than half. What they have done? They have appointed. Now here examiner will confuse you. You have actually appointed more than half, then you are controlling their management, right? So then also you will become a associated enterprises. Guys, it is not just one way, whether U Limited is holding more than half, or it can be this way also. Now, India Limited has appointed more than half, actually appointed more than half of the board of directors of U Limited, then also they will become associated enterprises. And any transaction which is happening between these two, make it the transfer pricing provisions will apply over here. Got it? Okay. So they have appointed. Now, examiner will confuse you. They will say that U Limited has power to appoint. They have the power to appoint more than half. Then also, will they become actually associated enterprises? The answer is no, guys. They should have actually appointed. So they should have actually appointed. If they have only the power that they can appoint more than half, but as of now, they have not yet appointed them, then you will not become associated. So power to appoint is not relevant. What is relevant is that actual appointed. If you have actually appointed more than half, then it would be they both will be an associated enterprises. Or let's say, even if you have appointed, let's say, for example, you limited has appointed even one director. Out of 20, he has appointed even one director. Sir, only one. But this is such a director. What type of director is he? Executive director. If he is an executive director, guys, who is an executive director? Mainly who has control of day to day control of the business. That person is an executive director. So if you have even appointed at least one executive director also now, so if you have appointed one executive director also, then also you both will become associated enterprises. Correct? So it could be more than half normal directors. But if you have even appointed one executive director also, at least one executive director also, then also you both will be the associated enterprises. See? So that is the reason I was telling you that you would be associated. Why? Because of equity 26% or more, because of management also. More than half of directors you have actually appointed. Power to appoint? No, power to appoint is not important. Actually appointed is important. At least one should be or at least you have appointed one executive director, right? Let's say, for example, similarly, this one, similar to this one. Let's say A Limited has appointed. Hmm, let's say A Limited has appointed more than half in B, and they have also appointed more than half in C. Same way. Then also, see, obviously A and B is no questions about it that A and B would be associated. No questions about it. A and C would be associated. But in this case, B and C will also be associated enterprises. Are you all getting it? Everyone, see, if you come to point number 5, so third and fourth I'll cover after this. 5. More than 50% of the board of directors or one or more executive directors, got it, of one enterprises are appointed by other enterprises. So are appointed, right? And actually appointed is important, not just power to appoint. So please don't get confused. Examiner will actually throw a trick on you. So they will say that they have the power to appoint it. No, power to appoint is not important. Actually appointed is more important, right? And 6 point is same, that you are appointing more than 50 of B, you have appointed more than 50 of C, then obviously A and B and A and C are actually associated, but B and C will also be associated. This is written in point number 6. Got it? Okay. Next is, now guys, I will be talking about hidden control. So we have done this also, that management also you are controlling. Now focus on this hidden control. Why you must be controlling, which we are not able to see from the naked eyes, but actually there might be some, you have actually laid some hidden control in the other enterprises. How? Let's say, for example, this is I Limited, India. It has assets, let's say, of rupees 10 crore of asset. It has, I Limited has 10 crore of assets. And this is U Limited, US, right? UINC US. So U Limited has actually given a loan. They have provided a loan to them. They have provided I Limited has done a borrowing. How much? More than 50%. More than 50%. Guys, please tell me, somebody is giving you such a huge amount of loan that more than 50% you are financing this company. So you might be having you might have laid down certain hidden control which we are not able to see. You might be more or less controlling them. So if you have, this is very important. This comes in examination also, right? This is one of the point there. So first they will say that there is U Limited company. They have given a borrowing. They have given a borrowing of this much dollars. Let's say, for example, they have given a borrowings of $5 crore and more than 5 crores, right? More, it not exactly 5 crores, more than 5 crores. And if there the assets are of rupees 10 crores dollars, then obviously you both are associated enterprises and you will apply transfer pricing provisions. And guys, let's say, for example, no other thing is given over there related to associated enterprises points, but only the borrowing is less than 50%, then please don't make them associated enterprises, right? So if they should be more than 50%. And another important thing is that's a 10 crore, what value you will take? Book value or market value of the asset? Book value, right? So please take the book value. So examiner will give you both the values. They will give you book values also, they will give you market values also. So please compare that 50% with respect to book value. This is written over here. A loan advanced by one enterprise to another enterprise constitute not less than 51% of the book value of the total assets of the entire entity. Not less than 51%. So it should be more than 50. So not 50.1, 50.2, it should be 51%, right? So at least 51%. And please apply on the total assets of the book value, not on the market value. Got it? So at least 51%, not just half, it should be more than that, 51%. Now, if let's say I Limited has borrowed a money. Let's say, for example, they have a borrowings, they have some loans in their balance sheet. They have some loans, right? They have some loans. Let's say, for example, they have loans of 100 crores. Loans and borrowings, they have of 100 crores. And guys, U Limited has guaranteed at least 10%. One enterprise guarantees at least 10% or more. Here, exactly 10% also, then also you will be associated enterprises. So you have given a guarantee of 10% or more of the total borrowing of the other enterprises. So actually, you are a guarantor of how much? At least 10%. So if you have given a guarantee of 10 crore also, 10 crore also you have given a guarantee, then also you might be. Why somebody will do you think that somebody will give a guarantee of any other person? The answer is no. Let's say, for example, your friend is purchasing a car, right? Your friend is purchasing a car worth rupees 20 lakh rupees, and the bank is saying, okay, we will give you the loan, but we need a guarantor. We need a guarantor that in case you don't pay this 20 lakh rupees loan, let's say he's taking a 20 lakh rupees of loan. So if you don't pay this loan, then we need a guarantor. That guarantor will pay. So your friend will call you that, boss, actually, friend, I am purchasing a car of 20 lakh rupees. I'm taking a loan of 20 lakh rupees and I need a guarantor that if I'll not pay, the guarantor will pay. So you are my best friend. So please become my guarantor. Do you think that you will become his guarantor? What you will say? Array, I'm not able to hear you. What are you saying? Right? Or today, I'm very busy, guys. I'm stuck in traffic. There is some emergency in my home. I'll not be able to come. So what you will do? You will make excuses, right? So you will not give guarantee to other person. Why? Because if he is purchasing a car, so he should take care of the money also. Why you will be paying 20 lakh rupees for on his behalf if he fails? So obviously nobody gives guarantee to anyone, right? Generally nobody gives a guarantee. So in this case, why they have given such a huge guarantee of 10% or more? So there might be some hidden control which we are not able to see with from our naked eyes, but actually there might be some hidden control. That is also one of the point that you both become associated enterprises. Again, an important point for you. Everybody is understanding it. So one enterprise guarantees 10% or more of the total borrowings for the other enterprises. Next is seventh point. If you are actually um, dependent on the other enterprises, why? Because of their know-how, because of their manufacturing process, then also you become an associated enterprises. So manufacturing, processing, business carried out by one enterprise is wholly dependent on the use of know-how, patents, copyright, trademark, license, design, secret formula. You cannot work without that particular know-how. You cannot work without that technology. Then also you will become an associated enterprises. Eighth point is important, that at least whatever the raw material which you purchase. So let's say, for example, there is I Limited. Let's say in during the year they purchase some raw material, right? And 90% or more of the raw material is actually supplied by U Limited. So if 90% or more of the raw material and consumables are supplied by U Limited, then also you will become associated enterprises? No. One more condition. So at least 90% should or more should be there. Plus You Limited actually is controlling you. He is saying that I will supply at least 90% of the raw material I will supply, or more I will supply, and I will only actually decide the price. So I will only decide the price. You don't have any say on it. You don't have any, you can't say a word on it. I will decide the price only. So see, we have to purchase 90% or more raw material also from them. And the price will also be decided by you Limited. Then in that case, it would be a associated enterprises. So it's written over here, 90% or more of the raw material and consumables required by one enterprises are supplied by other enterprise, and the prices are also influenced by that supplier. Then also it would be an associated enterprises. Right. Nine point. It says that if you are, guys, please tell me, generally in any transaction, who decides the price? The buyer or seller? Generally, whenever you go to market, and who decides the price, the buyer or the seller? The seller, obviously. See, if you will go to, let's say for example, you are going to purchase clothes, so what you will say, you have actually selected a jeans, and what you will say, you will pick up this jeans and you will say, I will pay 100 rupees for this jeans. Do you think that you say this like this? No, you ask from the seller that how much it is for. So generally, who decides the price? Generally, seller decides the price. But let's say if there is any transaction where buyer decides the price, if buyer is deciding the price, right, 100% buyer is deciding the price, then again it would be a, why buyer is deciding the price? Because might be he's controlling the other party. So there is also a hidden control. So if any prices are actually determined by the buyer, so it says the goods and articles manufactured by one enterprise is manufacturing it, and who is are sold to the other enterprises, but the prices are influenced by such buyer. If the buyer is actually influencing that price, then also it would be an international transaction. Guys, here, please don't get confused. Here they were saying that seller is deciding. Generally seller decides, but they are also supplying 90% or more. So they are actually controlling over here entirely to you. 90% or more of the raw material they are supplying, plus they are also deciding the price also, right? Because buyer was not able to say a word over here, the entire price is influenced by the supplier. Then also it is an associated enterprises. Here also, if your buyer is deciding the prices, and here there is no such condition of 90% also, right? So here if buyer is deciding the prices, then you are again associated enterprises, right? Guys, actually, this TP law came very late in India, and the first country where this transfer pricing came, it was UK. And most of the countries have actually taken the transfer pricing law from UK. And since India is also one of them, they have taken mostly the transfer pricing provisions from the UK law itself. So till point number 9, what we have discussed was in UK law also, which we have taken it, right? But point number 10, 11, and 12, they are specifically, in fact, mostly 10 and 11, they are more from Indian context point of view. So actually, people were doing like this also. They have, this is not in UK law, but here it is in Indian law. So what it is, actually, what was happening is, let's say there is Mr. A. He's doing a business in India. So let's say, for example, he is doing a business in Tamil Nadu, in India, and he would like to sell something, let's say in Germany. They both are unrelated, they are not related. He would like to sell something to Germany, right? Let's say, for example, the transaction would be happening, let's say per unit price, he would like to sell it for 1,000 rupees. Obviously, here Mr. A is selling it for 1,000 rupees to them. Now, what will happen is he would like to reduce his taxes. So, what he will do, first, he will sell it. To, let's say, he make a company in Dubai. He will make a company, Mr. A will make a business or a sole proprietor concern. He will actually establish in Dubai. And what he will do, he will first sell it in Dubai to his Dubai concern, where he is actually the owner himself. So A will sell to his concern in Dubai, and let's say at rupees 150. And then from here, they will sell it to Germany for 1,000. So what they have done is actually, what they have done is, instead of selling it directly from for 1,000 rupees from India, so they have reduced the price over here. They are selling it for 150 rupees here in Dubai, and from Dubai they are selling it for 1,000 rupees. Why? Because in Dubai there is hardly any tax rate, right? Or this concern in Dubai is actually owned by Mr. A, or it can also be owned by Mrs. A, or any of his relative, right? Any of his relative or any of his HUF also. So if you have a business here in India, you have a business outside India also, whether you are carrying a business or your relative is carrying a business, and then also this transaction will also be considered as an associated enterprise transaction, and we will apply transfer pricing provisions here as well. So this point number 10 and 9 are very similar. So it says, if one enterprise is controlled by an individual, see, one enterprise is controlled by an individual, Tamil Nadu. The other enterprise is also controlled by such individual. The other enterprise where? Dubai. That is also controlled by such individual or relative of such individual or his relative or jointly together by such other individual and relative. Then also these two will also be called as associated enterprises, right? This is related to individual. This is related to individual. This was not in UK law, but it was in Indian law. So actually, there used to be a famous Dubai route. So people were using this route. They were actually manipulating the taxes by following the Dubai route. So they would like to break this Dubai route. So this, by inserting this point in transfer pricing, they have actually broken the Dubai route. The same way, 10th and 11th are almost similar. If one enterprise is controlled by HUF, let's say for example, here this is HUF. This enterprise is a HUF business. And let's say here in Dubai, they have opened, any of the member of the HUF has opened a business. So this transaction which is happening between HUF or another member of HUF, this will also be a associated enterprise transaction. So if one enterprise is controlled by HUF, the other enterprise is controlled by a member of such HUF or a relative of the member of the such HUF, then they both will also be called as associated enterprises. Getting it? 12th point. So let's say, for example, there is a partnership firm in India. There is a partnership firm in India. And let's say there is a non-resident Mr. Paul. He's Paul. And he has more than 10%. Let's say, for example, he has 11% profit sharing ratio in this partnership firm. So any transaction between Paul and this firm will also be considered as a associated enterprise transaction. So this is would be if any person holds not less than 10%. So let's say, for example, he's holding 11% shares. Oh, sorry, not shares, 11% profit sharing ratio in this partnership firm, in this AOP or BOI, then they both would be the associated enterprises. Getting it? 13 is general. If any relationship of mutual interest exists between the two enterprises as may be prescribed. So CBDT central government can prescribe some of the enterprises that if they find that if there is any mutual interest between them, they can also prescribe by rules. So 13 is general. So I believe that you understood section 92A. So 92A is quite a big section. It was quite a big section. And you should know that what is associated enterprises. Okay. Now, 92B we have done. What is international transaction? A transaction between two enterprises where at least one of them should be a non-resident. And if both are non-resident, then whether it is an international transaction, yes. If at least one of them has a taxable income in India, then also it would be an international transaction. Now, what is a deemed international transaction? Guys, deemed international transaction is also defined in section 92B. What is a deemed international transaction? See, let's say I Limited and U Limited. Let's say U Limited is holding 40% shares in I Limited. They both are associated enterprises. So U Limited and I Limited, they both are associated enterprises, right? And they now know that if they will do any transaction, between themselves, then they will apply transfer pricing provision. So in order to avoid it, what happens is, let's say, for example, they create a dummy party in between. So let's say, for example, you limited created a dummy party. Let's say, for example, Mr. X. You limited makes an agreement with Mr. X that what you have to do is, you are actually a dummy party. You have to do a transaction with I Limited. I am not doing it directly, but through you, I will do it. And they made an agreement, prior date agreement. They made a prior agreement between themselves. So you limited and X limited, there is a prior agreement between themselves. And let's say, for example, they say, now please, you both do a transaction. Guys, if you both will do a transaction, although I Limited and X Limited is not directly related. But why? Because this is actually a dummy party. There is a dummy enterprise which has been created in between. So any transaction which is happening between these two also, I understand they are unrelated. But transfer price, international transaction says that these two transactions will also be considered as a associated enterprises transaction. Got it? So we will also call it as an international transaction. Sometimes examiner can ask you that if the transaction is happening between two unrelated parties, can we also call it as an international transaction? The answer is yes. This is known as deemed international transaction. Deemed, we will assume, we will consider that this is also international transaction, right? So if there is a prior agreement, or let's say, for example, this dealing which is happening between I and X, who is controlling it? Let's say you is controlling this transaction. So this person is a dummy party, then it is a deemed international transaction. So it is written that certain transaction between unrelated person. See, these two are unrelated, but certain transaction. Why? Why? Because your associated enterprising is influencing this transaction. So it's written over there. Certain transaction between unrelated person shall be deemed to be international transaction if there exists a prior agreement between associated enterprises and unrelated person. So there is a prior agreement between you and X, then it would be a deemed international transaction, or terms of the relevant transactions are determined by A. So whatever the terms and conditions of this transaction, who is determining it? He is actually controlling from behind the curtain. He's sitting and he's controlling it. Then also it is a deemed international transaction. Got it? So I have made it over here also. This is Indian company X Limited. This is New Zealand company Y Limited, and they both are associated enterprises. So what they have done, they have actually made an independent party over here. This is a dummy party over here. So actually there is a prior agreement between these two, and he's saying, okay, on my behalf, you do a transaction with him. So this and this is unrelated, I understand. But this person, this transaction will also be considered as a deemed international transaction. Everybody's okay with this? Guys, this person can be a resident also, non-resident also, doesn't matter. So this person can be a resident also, non-resident also. So dummy party can be anyone, right? But still we will call it as an international transaction. Okay. So this was one part which was very important. Now I'm coming to the second part of it, which is 92. Okay. Let us see that the first box we have done it mainly. Specifically, we have not done what is specified domestic transaction, that we will be doing it separately. See, so now you know, first box you have done. Section 92, TP provisions, you know that when it will be applied. So whenever there is an international transaction or specified domestic transaction, then we will see that it should be at the arm's length price. This is section 92. 92A, what is associated enterprises, you now know. 92B, what is international transaction? What is international transaction? At least one of the parties should be a non-resident, right? Between two or more associated enterprises. And sometimes now we know there is something called as deemed international transaction also. Deemed international transaction. So 92BA, we have not yet done specified domestic transaction. Now I'm coming to this particular topic. Guys, these two together, I'm telling you, these two together in examinations. No, I'm not ignoring that these cannot come in examination. These also comes, but 40-50% you see that questions which are coming are actually based on these two. So the second part is over here is computation of ALP, how we will determine the arm's length price. Okay. Give me a minute. Okay. See, see, now there are various methods to compute ALP. See, whenever your transaction is happening at a particular price, and if it is an international transaction, so you have to give a certificate of the chartered accountant that it should be at ALP. Now that people, even your chartered accountant, assessing officer, transfer pricing officer, how do they determine the ALP? So there are some methods which are given to us. Basically, there are 6 methods which are given to us that how we determine ALP. One is called CUP method, which we call it comparable uncontrolled price method. What is this? I'll tell you. Resale price method, RPM, cost plus method, profit split method, transactional net margin method, and any other method as prescribed. Right. So first I'm talking about these methods which are given in 92C. So just remember 92C. C stands for computation of ALP or determination of ALP. How we will determine the ALP. Look into your notes, section 92C. See, the ALP in relation to an international transaction. So whenever you will be determining the ALP with respect to an international transaction, and also same concept will apply to specified domestic transaction that we will do, shall be determined by any of the following methods being the most appropriate method. This point is very important for you to understand. See, can we compute ALP from more than one method? Also, the answer is no. There are 6 methods, and you have to do only 5 because the 6th one is actually any other method as prescribed by the department. So we have to do 5 methods. So can we apply? We have to apply 1 method, 2 method, 3 method. The answer is no. In any particular international transaction, there could be only one is the best method, which we call it most appropriate method. Use this term in the examination that we can use only the one method which can be the most appropriate method. So you can't use 2 methods. You have to use only one of the method. Now, how we will come to an examination that which method we have to use? 90% they will tell you that you have to compare, you have to determine the ALP by using this particular method, controllable, comparable uncontrolled method, or cost plus method, or resale price method. Or sometimes now right we are discussing it, so you will be able to understand by reading the question that which method will be applied also, right? So we can use any of the methods which is actually given in the question. So let us first understand what is comparable uncontrolled price method. See, the name itself is saying that compare your transaction. Now, guys, please, I don't want you to learn anything. Guys, please don't learn anything. Just understand it with logic. Let's say, for example, there is I Limited. What is I Limited? India Limited, sir. Indian company. Okay. So let's say I Limited is doing a transaction with U Limited, which is Associated Enterprises. So U Limited, which is the associated enterprise. So let's say I Limited is selling something to the associated enterprise. Let me take it in Indian rupees. It can be in foreign currency also. It can be in Indian rupees also. Doesn't matter. Right. So let's say, for example, we are selling something to U Limited at rupees 800 per unit. Per unit, we are selling at rupees 800. Now, please tell me, what do we presume? We will presume, the lawmakers will presume that since this transaction is happening between two associated enterprises, so this value is not a correct value. It is a tainted value. It is not a correct value. It is not arm's length price. So how we will determine what is the arm's length price? So we will ask whether I Limited, India Limited, do you sell the same type of things? Do you sell the same type of things to any other people also? It might be possible. Now you might be selling it to other people also who are not related to you, who are unrelated to you, right? And we found that yes, they actually sell it to some other people also who are unrelated to them, and at a rate of 1200 per unit. They are selling it to others at 1200, the same unit, the same type of product or same type of services, whatever it could be. They are actually giving it to unrelated party at 1200, and to related party they are giving it 800. What will the assessing officer will say? Boss, this transaction is not a correct transaction. What is your correct transaction? 1200 per unit is the correct transaction. And let's say, for example, you have sold 1 lakh units to you limited. So on 1 lakh, on every 1 lakh, 400 rupees I will add. So 1 lakh into 400 lakh we will add in your income. So this is known as the transfer pricing provision. So this is how we determine the ALP. So first method is known as compare. See the name itself. I'm again and again telling you, don't learn anything. Understand it with logic. So it is called comparable because you are comparing now. So it is comparable. And with whom you are comparing it? With the related party? No, 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 no. That is an with unrelated party, which is not a control, because this transaction is a controlled transaction. You are being influenced by this transaction, right? This 800 rupees is an influence price. So we need an uncontrolled price, unbiased price, untainted price. So the name itself suggests comparable, uncontrolled price method. We also called it as cup and saucer, not saucer, CUP, cup method, right? So comparable, uncontrolled. Please repeat it with me. Comparable, uncontrolled price method. So we will take this as a base. So while computing, let's say while computing that how much we should add in his I limited income. So let's say they are selling something, because they might be selling something. Just imagine a P&L account of I limited, India limited P&L account. Imagine that they might be showing sale to related person, to associated person at 800 rupees, right? But this is not correct. It should be what? 1200. So 800, please replace 800 by 1200. So how much you have to add extra? You have to add 400 rupees extra, right? 400 for every unit which you have transferred to U Limited. So what is the base? 1200. Okay. Let me draw this also to you. You don't have to draw it right now. Just understand it. I want you to understand this with logic. So let's say this is the profit and loss account of I Limited. So they are saying that they have made a sale at 800, which we will say, no, 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 no. This 800 is actually not a correct price. So what we will do? We will delete it. We will delete it and we will say that please show it at 1200 rupees. Please show this as 1200 rupees, right? Do you think we'll be doing it in the books? The answer is no. While computing your taxes, we will include your 400 rupees also. We'll be doing it in the books also. That is known as primary secondary adjustment, that I'll be telling you later. But yes, it is part of that. In this chapter only, we'll be discussing that. But as of now, just while computing your income, we will add 400 rupees per unit in your income. Okay. Now, please tell me, we can take, that's okay, that we can take 1200 rupees. This is 60-70% done. We will take the uncontrolled price. Now, might be there is a little difference between these two transactions. Why? Might be there are some functional differences. Guys, what is functional differences? There might be some functional differences. Now, what does this functional differences mean? Very, very important. What does this functional differences mean? Now, guys, here students get confused, sir, whether we have to add, whether we have to subtract. Now, guys, it's very easy. I will be giving you certain situations. You have to tell me that what do you think that you have to add or you have to subtract. Let's say, for example, we are selling to unrelated person, this one. We are selling to them at 1200 rupees. But we are selling to U Limited at 800. See, 800 anyways is not a correct transaction. So we will not consider this 800 rupees. We will take 1200 as a base. So we will cut this 800, we will take 1200 as a base. But there are some functional differences. What it is? Let's say we are selling to unrelated people, very few units we are selling. Very few means we are actually, it's a retail transaction. However, we are selling to U Limited, that is in bulk. That is in bulk, right? Wholesale transaction. So please tell me, whenever normally I ask a normal business person that whenever you sell it in retail versus whenever you sell it in bulk, so whether both the prices are same, the answer is no. Whenever you sell in bulk, you give a little discount to them, right? So if I'm taking this 1200 rupees, which is a retail price, which is actually a retail price, right? But what we are selling to you limited is in wholesale. It's in bulk quantity. So do you think that 1200 is a correct price? No, sir. We have to make a little adjustment to it. We have to make a little adjustment to it. So let's say the differences between the retail and the wholesale prices, let's say rupees 20 rupees, right? So if we sell it, let's say for example, if we would have sold it to unrelated party in retail, we would have sold it at 1200. But let's say if we would have sold it to again unrelated party, but in bulk, so please tell me, do you think that we would have sold it at 1200? The answer is no. What we would have sold it for? 1220 or 1180? You have to tell me 1220 or 1180. No, sir. In bulk, we will sell it at less price. In bulk, we will sell it at less price. So we have to subtract 20 rupees and it will be 1180 rupees. Are you understanding? Because now see, this U limited and this unrelated are although comparable, but there was some functional differences. So just imagine in your mind, guys, it is only the first time that you will take little time, but after that, you will be able to do it without any error. I'm telling you. So you have to see that to unrelated party, you have to compare this transaction, which should be at the same level. It should be at the same level. Same level means that if it is, it would have been the same type of transaction. The bulk transaction would have been to unrelated party, then it would have been at 1180. So what you will do, you will subtract that. So let's say you have to subtract that bulk discount 20 rupees from it. So you have to take this transaction as 1180. Understood? You have to take it at 1180. Okay. There could be one difference is the quantity discount, the bulk discount. The another transaction could be, let's say, warranty. Let's say warranty. Whenever you sell to you limited, associated, you don't give any warranty. You don't give any warranty. But whenever you sell it to unrelated, you give warranty also. You sell it on retail. See, retail we have adjusted 20 rupees. Now you give warranty also. You give warranty also to them. Now please tell me, if you give warranty also to them, then please tell me anything whenever you sell with warranty or without warranty. Is it at the same price? Tell me, guys. You are a business person and you have two options that you have to sell it with warranty or without warranty. With warranty, without warranty. Sir, with warranty and without warranty, it would not be at the same price, because here, whenever we will be selling it something, some goods or other things with warranty, we will charge a little extra. So we will charge extra for warranty. But here we will take normal price of that without that extra amount of warranty. So I can say that this with warranty, it would be a little high price. It would be a little high price and this would be a little lower price. Let's say, for example, warranty amount is 50 rupees. 50 rupees. So this would be high by 50 and this would be less by 50. Correct now? So please tell me now, whenever you are selling it to unrelated 1200 rupees, it was with warranty. But with to you limited, it was without warranty. So then what you will do? So you will say that, sir, this includes warranty amount also, because I need to compare an unrelated transaction, which should be bulk transaction. So bulk, we have deleted, we have subtracted 20 rupees. With warranty also, without warranty also, we have to say. So it should be plus 50 or minus 50. Sir, minus 50. So what we will do? We will subtract 50 rupees of warranty also from it. So how much it will become? It will become 1130, right? So it will become 1130. So 1130 is actually the ALP, right? There might be some other functional differences. So there can be many functional differences. And now guys, you have to just apply your logic that whether you have to add that it or you have to subtract it. Okay, now I'll ask you, let's say for example, just understand with logic. Let's say for example, you are a business person and you have two options. Let's say to one customer, this is customer number one. He purchases in cash. Cash means no credit. No credit. He directly gives you the money. As in when you make this transaction, he gives you the money at that particular moment only. Right? It's a cash sale. And let's say to customer number two, he actually is saying that, sir, actually, I will not be able to pay you for next 2 months. So please give me credit of 2 months. Now what you will do? Please tell me whether your price would be same. The answer is no, sir. Because to this person, he is paying me right now. So from this person, I will charge less, right? And from this person, I will charge little more. Why? Because we are giving it on credit. Understand? Now, please tell me. Now, to unrelated person, let's say it is given in your question that it was a cash transaction. It was a cash transaction, whereas to associated enterprises, it was a credit transaction. Now, please tell me, you have to add, you have to subtract. Now, no, forget about add and subtract. First of all, here you are actually paying it, and this person is paying you at that particular moment only cash, right? So please tell me here the prices would be low, and here the prices would be little more. Why? Because you are selling it at credit. So please tell me on this price, because this 1200 rupees, you are adjusting this 1200 rupees. And this is right now with respect to, with respect to retail price, it was more, it was extra. With respect to warranty, it was extra price. But with respect to credit, it is a less price. So what you will do to compare this and this, because to them you are selling on credit, so obviously you will charge more. So what you will do, let's say for example, for that credit amount, the amount is, let's say, 30 rupees. So what you will do, sir, here actually we have done a cash sale, we have done a cash sale, but here we have done a credit sale. So here we have charged less, so this 1200 rupees is a lesser price. So what I will do, I will add over here 30 rupees, because to make it comparable, I need a retail price. So retail we have adjusted, I need a, because this was a retail price, I need a wholesale price. This was with warranty, I have, and this was without warranty, so I have subtracted without warranty. But this was cash and this was credit, so I will add that credit amount. Let's say for example it was 30 rupees, so how much it would be? This would be 1160. So 1160 is your arm's length price. Guys, this is nothing but a comparable uncontrolled price method. So what you have done, first of all, now guys, how, don't learn anything, how we have approached it. So first we will see that whether there is any uncontrolled price available or not. Guys, if, now please tell me, if there is no uncontrolled price available, then what will happen? Might be some other method, right? So this method might not be applicable over there. So if uncontrolled price is available, so probably uncontrolled price method, CUP method, you will apply over here. So what you have done, have you started with 100, 800, or you have started with 1200? So I will start with my untainted price. I will start with my unbiased price. So this is an unbiased price, and then you will adjust with the functional differences, right? So it is written over here. Comparable uncontrolled price method. What does it? It's saying price charged in comparable uncontrolled transaction. In price charge in comparable, just compare the same transaction, but that should be an unrelated party. So this is with the, you will start with the unrelated party, right? Unrelated party price. Okay, and just adjust this price with the functional differences, like after sale support, bulk discount, credit period, FOB, CIF. What is FOB, CIF? Let's say for example you are selling them at CIF basis. What is CIF? It includes your insurance and freight also. But here you are selling it at FOB, free on board. So you are not taking care of insurance or freight, they will actually take care of it. So please tell me, whenever you sell it CIF, so you sell it actually more value. And wherever you sell it at FOB, you sell it less value. So what you will do, because this is more and you have to compare it with the FOB price. So what you will do, you will add or you will subtract. So in 1200, because this is more, so we will subtract. It could be opposite also. It could be opposite also. Let's say this is FOB. See, if they both are FOB, this is FOB also, this is FOB also, then there is no functional difference because both are in at FOB, no adjustment related to FOB price. Now, let's say, for example, they are a little different. There is a functional difference over here. Let's say this is at FOB and this is at CIF. Then what will happen? See, whenever you are selling it at free on board, so obviously you won't be charging little less. And here you would be charging little more. So what you will do, because this is a lesser price, to compare it with this one, so you will add that insurance and freight amount also. Got it? So it's written over there. You will actually adjust for the functional differences. And generally, I have written it that when we can use this particular method, if the comparable price is available to us. See, if the comparable price is not available to us, we will not be able to use this method, right? I'll also show you with this help of an illustration also. Give me a moment. Okay, if you will see, say, hmm, okay, let us see this question. Question number 3. Okay, readable, guys. So this question says, question number 3. It says, Seagate, it's an illustration number 3. It says Seagate Incorporation US holds 30% shares in Seagate India Limited. Okay. So this is Seagate India. Let's say this is Seagate India. If you want, you can write with me, guys. Right? This is Seagate India and this is Seagate US. And they both are associated enterprises. How we came to know that they are associated enterprises? So 26% or more. So these people are actually holding 30% shares. So obviously, so this would be an international transaction. Why? Because they are actually associated enterprises. Now, Seagate India Limited manufacture compact disc. Seagate India is manufacturing compact disc. So what they are doing is actually they are manufacturing compact disc. Okay, this is the product disk they are manufacturing. Okay, and sells them to Seagate Incorporation and Microsoft Limited. Okay, so what they are doing is they are selling it to two people. They are selling it to Seagate and they are also selling it to Microsoft. They're also selling it to Microsoft. Now, please tell me who is an associated enterprises. Sir, here, this is an associated enterprises. So this transaction is actually a biased transaction. I will say that this transaction, we have to apply ALP. And this is an uncontrolled, this is an unbiased transaction. So you have to take this as a base. So this is actually the base which you have to take. Correct? Now, this is comparable. Now they are saying during the year Seagate India Limited, right? So what they have done is they have supplied 10,000 CD writers to Seagate Incorporation at a price of 2,000 per unit. So what they have done over here, they have sold 10,000 units at what price? At rupees 2,000. So please tell me 2,000 is a correct price. The answer is no. It could be a biased, it is a controlled price. And what we need uncontrolled price, right? So what will happen is now, and what they have done at a rate of 2,000 per unit and 100 CD writers, just 100, just 100. What does it mean? It means that it is actually a retail sale. So we have sold 100 units here. And at what price we have sold it for? 3,000 per unit. So we are selling it at rupees 3,000 rupees per unit. Please tell me what is an uncontrolled price over here? 3,000 rupees is the uncontrolled price over here. Okay. So we have the comparable price, correct? And now what is happening written over here? The transactions of Seagate India with Seagate Incorporation and Microsoft are comparable subject to the following differences. So there are certain differences. What are these differences? Let us see. The first difference. The first difference is while sale to Seagate is at FOB, sale to Microsoft is at CIF. What does it mean? Sir, this is an FOB sale and this is a CIF sale. So CIF, we have charged extra. In CIF, we will charge extra. If we want to compare it with Seagate Incorporation, so we have to, what we have to do, guys, should I add more over here? Or to compare it with FOB, we have to subtract. We have to subtract. So we'll start with this, that the comparable prices, how much? 3000, and subtract the functional differences. What is the first functional difference? This is freight and insurance. And how much it is for? It is for 550. So what I will do, I will subtract from here your freight and insurance. How much? 550. This is the first difference. Guys, correct? Okay. Second point, they are saying the sale to Microsoft are backed by free warranty for 6 months, whereas sales to Seagate are not backed by such warranty. So the sale to Microsoft. So here, whenever we are selling it to Microsoft, it is actually backed by guarantee. So here there is a warranty also. And here there is no warranty. Please tell me, if there is warranty, so we might have charged more here. So if we to compare it with this, so we have to subtract that warranty amount as well. And the estimated cost of warranty execution may be taken as 250. So what we will do, we will subtract over here, because this is actually why we are subtracting it, because we are taking this 3000 as a base and it includes the warranty amount also. So subtract that warranty difference. So what is this warranty difference? How much it is for? 250, right? 250. So 250, I will subtract it from here. And then in the next point, it says since Seagate Incorporation places a larger order, obviously, because they are selling it at 10,000 units, and here we are selling it only 100 units. So it is actually a bulk order. So it's written over here. Since Seagate Incorporation places a larger order, Seagate India has offered a quantity discount of 20 rupees unit to Seagate Incorporation. So this is a retail transaction, right? And this is a bulk transaction. So in bulk, we will give at a cheaper price, at a lower price. Here we would have charged extra. And how much is the difference? Is for 20 rupees. The difference is for 20 rupees. It is written over here. So what we will do, because this is an extra amount, if we would have sold it to any other person, let's say if we would have sold it at Microsoft, we would have charged 20 rupees less if it would have been in a bulk order. So we will subtract that quantity discount also. How much is set for 20 rupees? Okay, what else is written over here? One has to start. Okay, now I have given the answer over here. So this is the differences. Now please tell me, what is the comparable price now? So the comparable price should be how much? Just subtract everything. 3000 minus 550 to 50. It would be how much? 2180. So 2180 is actually the ALP. It is the arm's length price. And how much we will adjust now the difference? See how much we have sold it to Seagate Incorporation. We have sold it 10,000 units. So how much we will adjust? So we have charged how much, guys? We have charged 2,000 rupees from them. Very, very important point right now I'm discussing. We have charged 2,000 rupees. Just understand, you don't have to make it. Just understand this, guys. Let's say, for example, in your P&L account, you are showing it. Let's say this is the P&L account of Seagate India. They might be showing it that they have made a sale. They have made a sale to Seagate Incorporation US by sales. They are saying that they have made it at 2,000 rupees, right? But the correct price was 2180. So what we will do, we will cut it. We will say this is not a correct price. The correct sale amount should be 2180. Correct. And into how much we are showing it less? 180 rupees. 180 rupees less profit we are showing. 180 into 10,000 units. This would be actually the adjustment which we'll be doing it over here. Now, my question, so the answer would be how much? 2180 into 10,000. Oh, sorry, minus 180 into 10,000. It would be 18 lakh rupees, right? So 18 lakh rupees actually we will be adding it. The net effect would be 18 lakh rupees. We will be adding it in the profit of Seagate India. So 18 lakh rupees will be adding in the profit of Seagate India. That's okay. Now please understand one thing. So here, because we have applied arm's length price, very, very important point, guys, understand it carefully. So we have applied arm's length price over here. And because of that, now Indian government is getting a profit because Indian government will get more taxes. Why? Because we will add 18 lakh rupees as an income and we will get more taxes. So Indian government is actually happy. So Indian government is actually happy, right? But guys, if so we have applied ALP, guys, please understand. If we have applied ALP and government has become happy, then we will apply this ALP. So transfer pricing provisions will apply. But if the Indian government will not become happy by applying this TP provision, if the Indian government will become sad, then we will not apply the ALP provisions. When will Indian government will become sad? Let's say the ALP for this, let's say for the ALP for this would not have been 2180. Let's say the ALP would have been 1900. So we have sold it at 2000, but let's say 2000 is not the correct price. What is the correct price? 1900. Let's say the fair market value is 1900. We understand it should be recorded in correct price. But if we will record it at 1900, what will happen? Our sales will reduce, our income will reduce, our profit will reduce, and government will lose tax there. So government will become unhappy if your ALP is such that, which is the effect of decreasing your profits. If your profits are getting decreased, then Indian government will become unhappy. And if they will become unhappy, they will say that this chapter will not apply. So you have to remember, very, very important question, very, very important concept, examiner's favorite. So you have to see that, okay, first we have determined ALP, good enough, very nice, you have determined ALP. Now you have to see that whether you have to apply this or not, right? Whether you have to apply this or not. So in case, if the government is becoming sad by applying it, so please don't apply, right? So the government should always become happy. So they should always be happy, then only you will apply the transfer pricing provisions. Got it? Everybody understood the cup method? What is cup? Comparable. Tell me the full form. Comparable uncontrolled price method. Okay. Now, the second method, these all methods are very, very easy. I'm telling you. The second method is resale price method. The second method is resale price method. See, what will happen in resale price method? Again, the name itself is telling you that how you have to approach with the resale price method. I'll tell you the logic first. See, what happens is, again, you are company in India, you are I Limited, India Limited. So let's say this is India Limited. Okay. This is I Limited India. Let me make it here. Okay. Now you are purchasing something from your associated enterprises. You are purchasing something from associated enterprises. This is an associated enterprises, U Limited, US. And you are also purchasing the same type of product or services from unrelated person also. So you are purchasing it from unrelated person also. This is unrelated person. Which price is correct, guys? This price is the correct price. This might be an influence price. So this is actually an influence price. So this is actually a bias price. We will not take this. We'll take this. Now what you will do is you are purchasing it from here. You are purchasing it from here. Obviously, here might be you are purchasing it at a lesser value. Why? Because it is a purchase. It is a purchase. So in your profit and loss account, you might be saying that this is a purchase. You might be recording it at a lesser value, but we will say no, it should be at the correct price. Might be at a higher value. Then only government of India will become happy. Now please tell me, whenever you will purchase it from outside, so let's say these both are purchased from outside, what you will incur? You will incur some custom duty. You will incur some custom duty, some other purchase expenses. So which you will incur whenever you purchase it from here, you purchase it from here, you incur some expenses also, some purchase expenses. So there might be some purchase related expenses. Purchase related expenses. What it could be? It could be your freight, it could be your insurance, it could be your customs duty. So you might be incurring this also, right? After that, you might be charging profit also, and you would be selling it. And then you would be selling these products which you have purchased from outs from your associated, which you have purchased it from unrelated. You are selling the same product also to normal customers. So these are your customers. So these are your happy customers, and you are selling to these customers. Please tell me, to this customer, you will sell it at the same price, na? Because see, here the mark, these are unrelated customers, obviously. So here in India, whenever you will sell it, whether you have purchased it from associated, whether you have purchased it from unrelated, see, they will get at the same price, right? Because see, market is very competitive. You cannot say that I will sell it at a lesser price to them. No, to these people you will sell it at a same price. So this is known as the resale price, that whatever you have purchased from outside, when you will sell it, so this is actually, this is called a resale price. Resale price. Guys, we want this. Actually, we are computing the ALP for this transaction, right? So we will take this resale price. We will take this resale price as the base. So this should be the base. And what we will do, we have to come to this price. So what we will do, resale minus profit. So whatever is the profit margin, we will subtract that. See how you came to this resale price. Whatever is your purchase price plus purchase related expenses plus profit, you got your resale price. If I want to go back, how I will go back? So I'm starting it from here. I will subtract my profit. Then I will subtract my purchase expenses. Then I will get my this purchase price, which is the ALP. Now understand one more thing, and this method is also done. Now please tell me, let's say generally the correct price of anything which you charge, which you purchase from outside, let's say the correct price is 1,000 rupees, right? The 1,000 rupees is the price. And obviously from your unrelated, you might have purchased it at a higher price. Why? Because in your P&L account, you might be showing your higher expenses. So you might have actually purchased it for rupees 1,500. Correct. So this is not a correct price. This price we will not take it. This price will not take it. We have to determine the ALP. Now this price is the correct price. So please tell me, generally your freight, insurance, custom would be same in both the cases. It would be same. Let's say for example, this would be 200 rupees. This would be 200 rupees. And let's say profit you want of rupees 600. Let's say you want a profit of 600. So generally, when you purchase it from an unrelated party, you purchase it for 1,000, you incur 200 rupees as your other expenses, and then you charge 600 rupees as the profit, and you sell it for how much price? 1,800, right? So this is the resale price. You got it? So generally, whenever it is an unbiased transaction, unrelated transaction, so you purchase it for 1,000, you incur 200 rupees as your other expenses, 600 rupees is your profit, and you sell it for 1,800 rupees. So how much is the profit percentage you charge? Sir, 1,000 rupees is my raw material cost, or I can say my purchase cost. 200 is my other expenses. So 1,200 is my cost, and 600, that is means 50%. So we are actually selling at 50%. So 50% profit margin on your cost, 50% on your cost is actually your normal profit margin. Got it? But please tell me, this product also you might be selling it for how much rupees? Please tell me, this price, this product also, when you have purchased it from associated, will you sell it at some other price or 1,800 rupees only? Sir, I will also sell it for 1,800 rupees only, because I am selling it to my these good customers. So obviously it would be at 1,800 only. Now please tell me, what is the profit percentage on this? See, you are saying that you have purchased it for 1,500. Purchase related expenses would be common. So let's say 200 rupees is the purchase related expenses. So 1,500 plus 200. And how much is the profit over here you have earned? 100 rupees, just 100 rupees. 100 rupees the profit you have earned. So how much? It would be 1,500 plus 200, 1,700. You have earned 100 rupees only. So 100 divided by 1,700 percent is somewhere about 5.88%. Is it a correct profit margin? It is your normal profit. The answer is no, sir. actually my normal profit is 50%, not this percentage. So guys, please don't take the profit percentages of this associate enterprises. Why? Because this price is influence. This price is an influence price. Therefore, the profit percentage, let us say it is coming as 5.8%. This is also an influence profit percentage. So please don't take this. You always have to take your normal profit margin. So what you will start it from, your starting point should be, right? So your starting point should be the resale price. So what you will do, resale price 1800 minus whatever is your profit percentage. So please subtract your profit, normal profit. Will you take this profit of your associate enterprises, or you will take the profit of unrelated person? Sir, unrelated person. So 1800 minus 600, right? And then whatever is your purchase expenses, please subtract that also. So you will get 1000 rupees. So 1000 rupees is actually the ALP, right? If there is any functional differences, please adjust that also. So this is how what the ALP method is, this resale price method is all about regarding the determination of ALP. Understood? So it's written over here. See, if you will see in your book, what is resale price method? See, just compare it with this illustration which I have given it to you. What is resale price method? Start with the resale price. Start with the resale price and subtract the profit. Which profit? Of your associate or of your unrelated? Sir, unrelated, normal profit margin. So start with the normal resale price of the goods or services which are purchased from A. So which are purchased from A, but please tell me the resale price of this and the resale price of this would be the same now, would be same. So start with your resale price. So this is the resale price. And then what you will do, subtract from it the gross profit margin. Which gross profit margin, guys? The profit of A or profit of unrelated? It's the profit of unrelated. So minus normal GP margin in uncontrolled transaction. Got it? So subtract this. So after subtracting this, you will come up to this value. Then please subtract this, your purchase related expenses, or if there is any functional difference, subtract that. You will get your ALP of this transaction. Then any additional expenses in connection with purchase. Let's say, for example, you have done some common expenses, transit insurance, freight, custom duty, etc. So please subtract this also so that you can get this amount. And if there is any functional differences, let's say, for example, it's a retail transaction, it is a bulk transaction, you know how to do it, right? So plus or minus any functional differences also you have to adjust, right? Generally, when we actually use this method, so I have written it, generally we use this method whenever we resell it, whenever we resell it to another party. So we have purchased it from here and we will resell it to our customers without adding much value. So generally we use this, practically we use this method generally when we are into a trading business. We don't add much value over here. We don't incur some manufacturing expenses. So generally we are into trading business, or we are into a service industry, let's say in a software industry or other industry, we use this method. Otherwise, this is not important, guys, that where we use it for your examination. You should know how we will be calculating it. Let us do with the help of an example. So let us do with an example over here. Okay. So this is illustration number 4. It says, readable. So it says Red Bull Austria, okay, holds 30% shares of Red Bull India Private Limited. Okay. So this is Red Bull India. And there is Red Bull Austria, right? Are associate enterprises. So why? Because it holds 30% shares. Written now, 30% shares. Red Bull India Private Limited imports. So they actually imports. What they import? They import 1000 dispensers from Red Bull Australia at a price of 2900 per unit. So what they have actually purchased? They have purchased 1000 units at a rate of how much? It is written 2900. So at a rate of 2900 unit each. This is actually a bias transaction, right? This is the bias transaction. Now, and and they are sold to Hyatt Regency at a rate of 3,000 per unit. So what is Red Bull India doing is Red Bull India is actually purchasing it from Austria 2,900 and they are selling it to Hyatt. They are selling it to the customers for how much? They are selling it for 3,000. So 3,000 is actually the resale price, right? It's a resale price. Okay. What else is given over here? They have given that Red Bull India Private Limited has bought similar products from Ultimate Industries also and sold to Taj Palace as a gross profit of 12% on the sales. Okay. So they also, Red Bull India also purchase it from the Ultimate Industry. So there is some Ultimate Industries. So this is Ultimate Industry. They also purchase it from here and sell it to the customers. They also sell it to their customers. And how much they are selling it for? So it's not written. So obviously at 3,000, we might be selling it. And how much is the profit we earn? We earn a gross profit margin of 12% on sales. 12%. You have to remember, guys, whether the profit is given on cost or whether the profit is given on sales. So here the profit is given on sales. Okay. So what is the profit margin? So this 12% profit margin is of Red Bull or it is of Austria or on the products of Ultimate Industries? Sir, it is on the product of Ultimate Industries, 12% profit on sales. Okay. So this is when we are selling it. So it is at 12% profit margin on sales. Very, very important. You have to see that whether this profit margin is given on cost or it is given on sales. Now, Red Bull Austria offers a quantity discount. So there is a functional differences. We will say 10 rupees. So they actually give a quantity discount also. So here it is, we are getting a quantity discount also. Okay. And of rupees 10 rupees is the quantity discount. Whereas Ultimate Industries does not offer such quantity. So obviously their price might be more. So their price is more by 10, their price is less by 10. So 10, we have to subtract it also, because when we will get the price of this one, we have to subtract 10 rupees as the functional differences. That you know, I believe. Now, Red Bull India Private Limited incurred freight of 10 rupees and customs of 25 in the case of purchase made from Red Bull Austria. So there is some purchase related expenses also. How much is the purchase related expenses? 10 rupees on freight and 25 rupees on the custom duty. So obviously this is common expenses. So purchase related expenses 35. So 35 is the purchase related expenses over here that we know it's a common expense. Okay. And it's not given that it's not there in Ultimate Industry. So it's a common expense. So it is just a common expense. Now we have to determine the ALP. Guys, how we will start? So we'll start with this resale price. We'll start with this resale price. And from this resale price, so the resale price is, you can write it with me. The resale price is how much? 3,000. So what you will do is first subtract the profit. First subtract the gross profit margin. So how much it is? 12% on sale. And which is the profit, guys? Let's say, for example, they might have given the profit percentages of this thing also. So you would please don't take that profit margin. You have to take the profit margin of the uncontrolled transaction. So 12%, how much is 12% for? It is for 360 rupees. So 360 rupees you have to subtract for profit. Okay. Then 35 is the common expenses also, which you have to subtract. So these are purchase related expenses. So purchase related expenses, your freight, custom, etc. It is 35. Guys, corrected. And now there is a functional difference also of quantity discount. So here there is no quantity discount and here there is a quantity discount. So when you have subtracted 35 up till here, you have to adjust the quantity discount also, which would be subtract the quantity discount. How much it is for? 10 rupees. So you will get actually 3,000 minus 360 minus 35 minus 10. So you will get 2595. So your purchase price should be 2595. If you will see over here, actually 2595, and how much we have purchased it for? 2,900, guys. 2,900 we have purchased it for. 2,900 we have purchased it for. So in our profit and loss account, please remember what we are seeing. We are seeing that in our profit and loss account, we might have recorded the purchases 2,900 per unit. But it should be what? it should be less. So it should be less. How much is the purchase for? It should be of rupees 2595. This should be the correct purchases. So government will become happy or they will become sad? They will become happy. Why? Because their expenses are getting reduced. If their expenses are getting reduced, their profit will increase. How much it will be increased by for? 2900 is the difference, 305 rupees. So 305 rupees is the difference. And how much we have purchased? 1000 units. So this would be 3,05,000 would be the differences over here. That would be your, so the correct ALP is 2595. So the difference is 305, which will be adjusted, and 3,05,000 rupees by 3,05,000, we will increase your income. Everybody got it? Correct? So this was resale price method. Now come to next method, which is called cost plus method. See, again, cost plus method is very easy to understand. Let's say there is cost plus method. We call it, the short form is CPM, cost plus method. It's very easy. Again, please tell me, generally, let's say this is I limited. Please tell me whether I limited is selling it to something to associated enterprises, or they are selling it to unrelated person. Right? We are selling it to associated and we are selling it to unrelated person. What would be the same value? The same would be our cost. See, our cost of manufacturing, cost of production, whatever the cost which we are incurring, it would be same for both. Right? The price rigging, the incorrect price would be here, that whenever we are selling it for, let's say to them, whenever we sell it for, we sell at 10% profit margin, and generally we sell, let's say for example, our cost is 1000 rupees, and to associated enterprises we sell it for 1100, which is actually not a correct price. Generally our normal profit margin is, let's say, 25%. So generally my normal profit margin is 25%. So we sell it at, to unrelated person, we sell it by making a 25% profit. So generally we sell it at rupees 1250. Correct? So 1250 is the correct price. This is not the correct price. So what is it? Is cost plus method when you will use, generally when you are selling it to your associate enterprises. So whenever we are selling it to our associate enterprises, so let's say for example, it is given that 1100 rupees is the price which you have sold it for. We will say no, this is not the correct price. And the profit percentages which we have charged from associate enterprises, that is also not correct. So that is not correct. So from where we will start? We'll start. See, the name itself is saying cost plus method. So we'll start with our cost. So here we will start with our cost. So what is our cost of production? What is our cost of production or cost of manufacturing? So whatever is your direct cost, whatever is your indirect cost, please start it from here. So from 1000, we will start it from here. Correct? And what we will add in it? What we will add in it? We will add this normal gross profit. We'll add the normal gross profit. So plus normal gross profit, normal GP margin, we will add, so that we can get this price. This price is actually the correct price. So this is the ALP. And if there is any functional difference, you have to add or subtract the functional differences also. Understood? So see, the name itself is saying that start with your cost. Start with your cost and to whom you are selling it. So if you are selling it to associated enterprises, so obviously this profit is not a correct profit. So generally, you are in your cost, add your normal profit, and if there is any functional differences, please adjust your profits also with that. Okay. Again, I'll give you, with the help of this example, I'll show you that how we'll be doing it. I'll show you one of the question from the question bank. Give me a moment. I think there is a question over there, 10 or 11 in the question bank. Give me a moment. Give me a moment. Okay, good question. This is a study material question also, and it came in your examination also. Good question. Now, readable guys, this is question number 11 from the question bank. It says ABC Limited, Canada, holds 35% shares in Element India. Okay, so we have Element India and we are selling it to ABC. This is ABC Canada and they are holding 35% shares in Element. So they both are associated enterprises. Got it? So they both are associated enterprises. Now, ABC Limited Canada holds 35% shares in Element. Element India develops software and does both on-site and off-site consultancy services for their customers. Okay. So what are we doing is we are actually doing the consultancy for our customers. Okay. Element Limited during the year built ABC Limited Canada for 120 man hours at rate of 1800 per man. Okay. So what we have actually given it to them, we have given it to them services. For how many hours we have given it to them? We have given it to them for 120 hours at rate of 1800 per hour. So it is 120 hours at rate of 1800 per hour. So this 1800 might not be the correct value, right? So this is actually, we have built it for. This is our purchase transaction or a sale transaction for India. For India, it is a sale transaction. Got it? So it might be the position that this is a sale transaction. We are recording it at rupees 1800 rupees per hour. Might be this is not the correct price. It might be 2000, 2100, 2200, whatever it is, right? So let's say if it is more than 1800, then Indian government will become happy. Let's say if the ALP comes less than 1800, the Indian government will become sad and they will not apply ALP in that case. Okay. Now, the total cost, direct and indirect, for executing this work amount to rupees 2,25,000. So our cost is how much? 2,25,000. So 2,25,000 is the base, guys. But what we have to do, we have to take the gross profit margin whenever we sell it, whenever we give similar type of services to others. We have to see that how much is the profit margin we make. So whatever we have given it to them, so how much we have charged it for? We might have charged 120 into 1800 for them. And will you calculate this profit margin? No, this is a biased profit margin. So what we will see, who is our unrelated party? So whenever we have given to the unrelated party, how much is the profit we have charged? Okay. However, Element Limited built XYZ India at a rate of 2800 per man hour for the similar level of manpower and earned a gross profit of 50% on its cost. They are saying that actually have built it for 2800 rupees per man hour to them, 2800 per man hour to them, and our gross profit is how much? Is 50% on cost. So what it is? This plus 50%. So this is the correct. 50% is the profit. Percentage is on cost. Understood? Got it? Now, okay. So this is actually the correct price. So what we should generally do? Generally see, whenever we have built it to them, it is actually not the correct price. So the correct price should be whatever is the cost we have incurred for them. That is 2,25,000. See, 225 is not biased because that is the cost. So 225 is the cost for us. So what we should add? We should add 50% on this on cost so that we will get the correct price of this. So we will see that whether this is the correct price. The answer is no, might be. So if this is actually whatever we will calculate by adding 50%, so this should be the correct price. Can you tell me the total of it, what it is? 120 into 1800. So actually we have charged 2,16,000 from them. So we have charged rupees 2,16,000 from them, which is of course, I believe would not be a correct price. Why? See, our cost is only 225. How can we charge 216 for them? So it is totally an unbiased price. Let us see. So what we should do? So actually 2,25,000 plus 50% on this. So that should be the correct price. Okay. The transactions of Element Limited and ABC Limited and XYZ are comparable subject to the following differences. Okay. So there is some differences also. While Element Limited derives technology support from ABC Limited, there is no such support from XYZ Limited. The value of technology support received from ABC Limited may be put at 18% of the normal profit. Okay. Guys, first of all, I will tell you this question in a very easy manner, that how you will be doing it in an easy way. First of all, I will tell you the easy manner, and then I will also tell you that how the institute is actually done in the study material also, because this is a study material question. First of all, understand the concept first. See, the method name is cost plus method. Please write with me. The method name is cost plus method. So what we will do, we'll start with our cost. So what is our direct and indirect cost of the services which we have rendered it to our associated enterprises? So our cost is actually how much? 2,25,000. So 2,25,000. Actually, I would have built to them by adding 50% normal profit margin. Understood? Is 50% normal profit margin I would have built to them. So what I should do, I should add the normal gross profit. Normal gross profit. How much? Which is 50% on cost. So how much is 50%, guys? 2,25,000. It is on cost. So this is my cost. So there is no worries. What I can do, I can directly add 50% to it. So into 50%, which is 1,12,500. 1,12,500. Correct? So please tell me, generally, let's say, for example, there would have been no functional differences. Let's say there would have been no functional differences. So actually, I would have charged 3,37,500 from them. Correct? And how much I have charged it for? For just 2,16,000. So no. We will not accept this. Government is actually not okay with this. They will say, no, please charge this much amount from them. And then government will become happy. Understood? Now, let's say, for example, there would have been no functional difference. Forget about all the functional differences. Let's say there would have been no functional difference. Yes, this is the ALP done. Question completed. Are you all okay with me? Okay. Now let us see these functional differences one by one. Correct. Just give me a little moment. See, now they are saying that while Element Limited derives technology support from ABC, there is no such support from XYZ Limited. The value of technology support received from ABC may be put at 18% of the normal gross profit. It's very important, 18% of the normal gross profit. So what are they saying? There is a functional difference. They are saying that whenever we are actually providing services to ABC Canada, we are getting a tech support from them. But to unrelated person, whenever we are providing to unrelated person, we are not getting any tech support from them. So see, obviously, whenever you are providing it to some other party and you are not getting any support, so you will charge extra from them. But here you are getting a support, so you will charge at a lesser price. So what is the functional difference over here? So in ABC Canada, we are getting a tech support. So obviously we will charge less from them. How much less we will charge? It is saying 18% of the normal gross profit. So this is the normal gross profit. So 18% we have charged extra from these people, but from them we will charge less price. So what we have to do? We have to subtract, because this is actually the normal ALP without that tech support, because if we'll be getting a tech support from them, obviously we'll charge less. So you have to subtract less tech support. And how much you will subtract, guys? You will subtract 18%, right? 18% of this amount. This is important. 18% of this amount of your gross profit. So it would be 18% of 1,12,500, 20,250. So 20,250 you will charge less. Understood the first functional difference? The second difference is, as ABC Limited gives business in large volumes. Okay. So ABC Limited is giving you business in large volume, correct? Whereas there might be a retail business. So ABC gives a business in large volume, whereas uh, Element offered to ABC Limited a quantity discount, which will be valued at 10% of the normal gross profit. So what we are doing is, because they are giving us in bulk, so we have offered them a 10%, we have given them a discount. And how much is the discount amount is 10% of the normal gross profit. So obviously when we are giving it to unrelated party, they are not at a bulk. So obviously we'll be charging high. You know this adjustment now. So what you will do, you will subtract for the bulk discount, and how much it is? It is 10% of the normal gross profit. So again, of this profit, it would be 10%. So 10% of this, it would be 11,250. Are you all understanding it? Why I'm subtracting it? Because this price is actually without that discount. But to our associate enterprises, there is a functional difference that we are actually giving them a bulk discount. Now, next, in case of rendering services to ABC, Element neither runs any risk nor incurs any marketing cost. Okay. So whenever we render services to ABC, so there is no risk. First of all, here I can write there is no risk and there is no marketing cost, no market cost. Okay. Now, whereas they are saying on the other hand, in case of XYZ Limited, Element has to assume all the risk and cost associated with the market function, which may be estimated at 12% of the normal gross profit. Okay. So whenever we are giving these services, to unrelated party, so there is risk also. And there is extra marketing cost also. So please tell me that whenever we are giving it to them, we are assuming the risk also, the cost also. But to our associated enterprises, this is the another functional differences. So please tell me from whom we will charge more. So obviously, because we are assuming risk over here, we are taking risk. Cost is involved. So we will be charging more over here and we will charging less over here. So right now we have this value. So what we will do again, add or subtract? We will subtract, sir, because we want this value. So we will subtract. This is the amount related to risk and market cost. How much it is? This is 12% of the normal gross profit. So again, for this amount, 12%. So how much it is? 1,12,500 into 12%. So this is 13,500. Correct? So we have done three differences. Is there any other difference? Yes, one more is there. So they are saying Element offered 1 month credit to ABC. The cost of providing such credit may be valued at 2% of gross profit. No such credit was given to XYZ. Okay. So to our associated enterprises, we are actually offering a credit. Okay. So in this case, guys, to them, we are actually offering them a credit. And here there is no credit. So please tell me where the value would be more. So obviously we'll be charging to ABC Canada because we are selling it on credit. So whenever we sell it on credit, we charge extra. But whenever we are selling it at the cash price, we are not giving a credit, so we will charge less. So this is actually a lower amount, and here we have to go to add the credit amount also. And how much it is for? It is 2% of the gross profit. So this is 2% of this gross profit. So what I will do, I'll subtract or I'll add. Guys, I will add now because we will charge more from ABC Canada. We are selling them on credit. So 2% will be added. So here I will add the credit element, which is 2% of the gross profit, 2% of gross profit. So it would be 1,12,500 into 2%. This is 2250 will be added. So this is only the functional difference. And then they are telling us that compute the arm's length price along with the income to be increased under the cost plus method. So how much would be the amount? 3,37,500 minus 2,250 minus 11,250 minus 13,500 plus 2250. So this is 2,94,750 is actually the ALP. So this is the ALP. Got it? So 294,750. Is my calculation correct? Let me check it once again. 7,500 minus 20. 250 minus 13,500 plus 2250. I think it's correct. 294,750. So 294,750 is the ALP. And please, guys, now tell me that how much we have charged it for. We have actually charged only 2,16,000. We have charged only 2,16,000. So we have charged less. So we have to actually increase our income minus 2,16,000. It would be 78,750. By this amount actually will increase our income. Understood? Got it? Now, guys, there is another method also, which the way the institute actually solves it. It is also, in fact, I would suggest you. So this is for your understanding that you can do it like this also. But I would suggest that rather adjust the percentage profit. Adjust the percentage profit. How you will do it? So it's again very easy. See, first of all, tell me, what is the normal gross profit percentage? 50%. So here, what is this? So here the gross profit percentage is 50%, right? So what you have to do is I can write over here 50% is the adjusted gross profit, which I have to add in the cost. So my cost is 2,25,000 and I have to add 50% over here. Now what they were saying that due to tech support, because our associated enterprises is providing a tech support, and for that they are actually getting an advantage of 18%. 18% of what? 18% of the normal gross profit. So please tell me what I would do is, see, I have calculated in amount wise. If you will see the numbers, the amount, this is 18% of my gross profit, right? But let's say, for example, I have only percentage. So what I'll do, I will subtract 18% of this 50%. So 80, what is 18% of the gross profit? The gross profit is actually 50%. So 18% of 50% is 9%. Got it? So how I'm getting 9%. So students generally get confused at how we are getting 9% over here. So I believe that you have understood the background that why you are getting, because it is actually 18% of this amount, 18% of this amount. And this amount is how much in percentage terms? It is 50% of the cost. So 18% of this amount, it means 18% of 50% would be 9%. So what you will do, you will actually subtract 9% from here. So 9% you will subtract it from here. Correct. So actually after this adjustment, your gross profit will become 50% minus 9%. It will become 41%. Similarly here, there is a bulk discount of 10% of profit, 10% of profit. And please tell me how much is my profit? 50% in percentage term. So 10% of this 50% becomes 5%. So what I'll do, I'll subtract 5% from here of the bulk discount. Similarly, risk and marketing cost. How much was the risk and marketing cost? Risk and marketing cost was 12%. 12% of this amount. So in percentage term, it is 12% of 50%. Then how much it will become? 6%. So 6% I will subtract from here also. And at the last, there was a credit thing which I have added, 2% of your gross profit. So 2% of 50%. 2% of 50% is 1%. So I will add 1% over here. So actually, what is my, if I will tell you that how much is my adjusted gross profit margin, so what you will do, just sum them up. So it would be 50 minus 9 minus 5. See, 18 is not that. So minus 9 minus 5 minus 6 plus 1. How much is the percentage now? 50 minus 9 minus 5 minus 6 plus 1. So this becomes 31%. Everybody is okay with this 31%. So what I can do, my cost is, let's say my cost is 2,25,000. And how much profit I should charge? Adjusted profit 31%. So I can do directly. I can do directly also that 31% I will do I will add the profit over here. So it will become, so how much is 31%, guys? Of 2,25,000. So this is 69,750 is the 31% on cost. So if I will add this profit, so how much it will become? Plus 225,000, it will become 2,94,750. See, same amount which we have calculated over here, the same ALP we got by this method also. So I believe, so this method, why I have actually discussed it, to make you understand that what is happening in the background. But guys, I would request you to follow this particular method. Understood, everybody? So 294,750 and 2,16,000 is the actual transaction price, but we have to take the ALP as 294,750. So how much is the difference? 78,750. This 78,750 is actually the difference over here. I believe you got it. So this was which method? Cost plus method. So let us understand another method also. So this was cost plus method. Direct plus indirect cost of production of goods or services to A, whatever is the cost which you are incurring to sell it to A, whatever is the cost, and please adjust the profit margin also, and this profit margin should be adjusted. So the gross profit margin shall be adjusted for functional differences like tech support, quantity discount, risk associated, cost of credit, which we have seen in our example as well. Got it? Okay. Next method is very easy, not very favorite of the examiner. Examiner does not generally ask. See, cup method, resale price method, and cost plus method. These three methods are little important from examination perspective. If you will pick up the last year papers, you will find that mostly the questions are from these three methods. Profit split method, I don't think that they will ask. They have never asked in the past also, and I don't think that they will ask also. Otherwise, it's very easy method. Let us understand this method. See, what happens is profit split method. See, this method would be applied when there are actually more than one person are involved in executing a particular project. So generally it happens in a joint venture type of transaction. So what happens in joint venture? Let's say, for example, there are 2 or 3 group companies are working to execute an order, to execute a project. Let's say this is India Limited. Let's say the parent company is U Limited, US Limited. This is the parent company. Let's say, for example, they have one more associate enterprises. Let's say there is Mauritius Limited. M Limited is a Mauritius based company, right? So these three are actually working together on a particular project. So let's say they got a project from some external client, that they have a project which they have to conduct, and all three have to conduct them. All three have to, we need expertise of, let's say, US Limited also. We need expertise for India Limited also. We need expertise of Mauritius Limited also. So let's say this order is for, we have got a project, and let's say we are getting rupees 20 crores. Let's say, for example, in rupees terms, I'm taking it. So let's say we are getting 20 crore from that particular person. And the cost of this project is, let's say the cost of this project is 16 crores. So we have to incur 16 crore rupees on this, and 4 crore is actually the profit. 4 crore is actually the profit, right? Now, what we have done is actually, we have split this 4 crore rupees. This 4 crore rupees has been shared between these three. 1, 2, 3. These has been shared between all of us. Let's say, for example, they are saying, this group company is saying that out of this 4 crore, 3 crore we will keep. 3 crore profit we will keep. M Limited, they are giving, let's say, 60 lakh rupees they are giving to M Limited, and only 40 lakh rupees they are giving it to I Limited India. So because in India the tax rate are a little higher, so what they are doing is they are just giving 40 lakh rupees to India. Okay. So whether this profit split has been done at an arm's length price, the answer might be no. Now we have to analyze that who has performed how much, what are the functions they have performed. So let's say, for example, in this transaction, in this whole transactions, let's say I Limited is the one person, India Limited is the one person that they have performed let's say 50% of the functions, 50% of the functions I Limited has performed to execute this particular order. So please tell me, if we have performed 50% of the functions, then obviously of this 4 crore, we should get how much? 2 crores. So we are getting just 40 lakh rupees. It's not a correct price. 40 lakh rupees is not a correct price. So it should be actually, we should have received at least 2 crore. So we will also make it at an arm's length price. So this is known as profit split method. So please tell me that at what ratio, at what are the parameters you are actually taking to split this profit. So it could be on the basis of functions also. It could be on the basis of functions. It can be on the basis of assets employed. Let's say to execute this project, we have deployed 50% of our resources. We have deployed 50% of our assets. So obviously we should receive not 40 lakh, we should receive at least 2 crore of profits, right? This is known as a profit split, that whether your profit split is on a normal parameters or not. So whatever the functions which you have performed, whatever the assets you have deployed, whatever the risk you have taken. Let's say, for example, India Limited has taken the major risk. Let's say, for example, our customer was saying that if you will not be able to execute this project, so I Limited would be penalized. Let's say mostly the risk which is being taken by I Limited. Let's say 80% of the risk they are taking. So obviously, if you are taking more risk, you should get more profit also. The higher the risk, higher the profit. So all this profit should be split as per the, should be divided as per the following parameters. It could be functions, it could be assets deployed, it could be the risk assumed. We call it FAR analysis. We call it FAR analysis. What is FAR analysis? Functions, assets, and risk assumed, right? So for functions which you have performed, assets which you have deployed in this particular transaction, or the risk which you have assumed. So it should be on the FAR analysis. Now, it's written over here. So what is the profit split method? So first understand this. Share of profit computed on FAR analysis. What is this FAR analysis? So I have written it over here as well. The functions which you have performed, the assets which you have deployed or employed, or the risk you have assumed. So it should be on FAR analysis. So let me give you an illustration for this. Mm-hmm. Uh-huh. Give me a moment. Okay. See, let's see. Illustration number 5. It says Poster Incorporation, incorporated in UK, they have received an order to develop a software for Nano Incorporation USA for a consideration of $2 lakh. So what they have done is, Poster Incorporation, they have received an order. This is Poster Inc. This is a UK based organization. They have received an order from Nano. Okay. So they have received an order from Nano US. How much they are charging? They are charging $2 lakh. Okay. Now, for a consideration of $2 lakh, Foster Incorporation executed this order in a joint venture with Z Limited and Reliance Limited, two Indian based companies. Okay. So Foster Limited is here. They have actually carried out this transaction in a joint venture. So there are actually two associated enterprises for them, and Reliance Limited holds 35% shares in Z Limited and 28% in Foster Limited. Okay. So Reliance is actually holding 35% shares in Z. Okay. So Reliance and Z is associated, and Reliance is holding 28% in Foster. Okay. So here they are holding 35% in Z, and in Foster's they are holding 28%. Got it? And we know obviously Reliance, this is Reliance. So Reliance and Z is associated, no doubt about it. Reliance and Foster is associated, no doubt about it. And both of them would also be associated. Why? Because they both are being held by Reliance, which has 26% or more. So obviously these Foster and Z Limited and Reliance, they all are associated enterprises. Okay. And this project, these three are actually working to execute this project of $2 lakh. Now, let me read it once again. Foster Incorporation received an order to develop a software for Nano. So Nano has given them an order of rupees of dollar 2 lakh rupees, not rupees, $2 lakh. And Foster executed this order as a joint venture with Z and Reliance, and we know that these all three are associated with themselves, between themselves. The consideration of 2 lakh is distributed among Foster and Reliance as follows: 1 lakh to Foster's. Okay. So this, out of this 2 lakh, how they have distributed it, they have given $1 lakh to Foster. Okay. And they have given 50,000 to Z. They have given 50,000 to Z and 50,000 to Reliance. Okay. $50,000 they have given to Reliance. So this is how 2 lakh is distributed. 2 lakh is the selling price, right? The cost incurred to develop the software is 1,60,000. The total cost incurred is, see, 2 lakh, Nano is giving us 2 lakh rupees or $2 lakh, and the cost which we have incurred in the entire order is 1.6 lakh dollars. So $1,60,000 is actually the cost. So what is the profit, guys? So we can say 40,000 is the profit. So this profit we need to split it. This 40,000 profit needs to be split. Okay. Now they are saying Z Limited contribution to the combined net profit based on the functions performed is 40%. So Z Limited has actually performed 40% functions in this particular order. So for this particular order, we have performed 40% functions. Okay. So, and it is given the cost incurred by Z Limited is 42,000, and they have incurred how much cost? 42,000. What is this 50,000? Yes, 50,000 actually they have given. They have given us, Foster has given us $50,000, but this is not the correct price. So 40,000 is not the correct price. And see, if we have Z Limited, if they have performed 40% of the functions, so this profit, out of this profit, we should receive 40%. So how much we should receive? We should receive actually $16,000 we should receive. Correct? And how much is the cost which we have incurred? So we have incurred $42,000 as a cost. So $42,000 cost we have incurred. So please tell me what should be the arm's length price. So we can say, Z Limited can say, boss, 42,000 is my cost, and I have performed 40% in this order, in this particular work. My functions performed is 40%. So I need 16,000 is my profit split. So this is my cost. This is my profit split. So actually I should receive $58,000. So $58,000 is the correct price. If you are giving me for 50,000, 50,000 is not the correct price. $58,000 is the correct price. So ALP is 58,000, and my profit, Z profit, will be increased by how much? $8,000. Understood? So this is called profit split method. So how we have computed it? Whatever the cost with Z has incurred, 42,000 rupees, plus what should be his share of profit on FAR analysis. So here it is given to us that the profit split method, the total cost incurred by the assessee. So here Z Limited, how much cost they have incurred? So they have incurred 42,000 rupee dollars, and the share of profit on FAR analysis should be $16,000, and the ALP should be $58,000. Understood? So this is the profit split method. Not so important from examination point of view. Okay, the last method is called transactional net margin method. So this is also a very easy method. In transactional net margin method, what we need to do is, see, it is little bit similar to cost plus method. It is little bit similar to cost plus method. See, in cost plus method, what we were doing? Please tell me, in cost plus method, what we were doing? We were taking our cost. Here also, in transactional net margin method, we'll be taking our cost. Will be starting point will be our cost. That what is our cost? Let's say, for example, we have provided some goods, or we have given some services to our associated enterprises. So we start with the cost. And what we were adding? We were adding our normal gross profit margin. We are adding our profit margin, normal profit margin, plus some functional difference, of course. And this is my ALP, right? So what we were seeing that, let's say, for example, we are I Limited, India Limited. And let's say, for example, whatever the cost which we have incurred in supplying to associated enterprises, plus what is a normal profit margin. If I will be selling it to somebody else, then how much profit we will be actually earning. So it is our profit only. India Limited, your profit only, we will take your normal profits. But sometimes it might be possible that, let's say, for example, India Limited is not supplying to anybody else. Let's say we don't have a comparable transaction. Then this transactional net margin method is telling you that you can add the profit margin. You can add the profit margin of others also. So who are very similar to your business, similar industry, you can take the profit margin of others also. So this is the basic difference in cost plus method and transactional net margin method. So here the starting is same. Starting will start with the cost, but here we will take the profit margin of other enterprises, right? So of others, if there is some other company in our industry, so we can take the profit margin for them as well. So it is there, it is written over there. What is transactional net margin method? Total cost incurred by the assessee. So whatever the cost which assessee is incurring, we will take it, same like cost plus method, plus net profit margin, same like cost plus method. But there we were taking the net profit margin of ourselves, normal net profit margin. But here, net profit margin of whom? Of any other similar enterprises, of any other similar enterprises who is in the same industry. So we can take the profit margin of that also. And if there is any functional differences, we will adjust that as well. So this is known as TNMM, transactional net margin method. Understood? Should I explain you with a question? Okay. Let us do a question also. Give me a moment. There is another question in the question bank. There might be a question. Yes, this one. Okay. Let us do that. Now, it says, this is question number 15 of the question bank. It says, Andes Incorporation is having a business in Malaysia. Okay, so there is a company which is known as Andes Incorporation and they are in Malaysia. Okay, good enough. They have advanced a loan of 1,60,000 Malaysian dollars to Andes Limited India. Okay, so they have given a loan. Now we understand one thing, that when we become an associated transaction, so whenever we give a loan and if it is 51% or more of our book value of our assets, so I believe they have given a Malaysian dollars. I'm writing it in dollars only, right? Dollars, although it is MD, but I'm like writing it in dollar. How much loan they have given? 1.6 lakh. So they might be giving the book value of the assets also in India. So this is ND's India. How much is the book value? So if the market value is given, please don't get trapped over here. You have to take the book value. So book value would be given to you. So book value of the assets of Andes Limited was 125 lakh. So this is 125 lakh. Now, guys, there is one important point where students generally make a mistake. See, they both, please don't compare this 1.6 lakh with this. Why? Because this is in Indian rupees and this one is in Malaysian dollars. So please don't compare. No, sir, it is less than 51%, 1.6 lakh. If I divide by 125 into 100, so it is less than 51%. So we are not associated. No, this is in dollars, Malaysian dollars. Have they given the currency rate? The currency rate is here. Yes. 1 Malaysian dollar is equal to 45 rupees. So please tell me, I will multiply it by 45. Now please tell me whether it is 51% or more or not. So this is 45 into 1.6. The total I get 72. So 72 lakh is actually rupees 72 lakh divided by 125%. 57.6%. Yes, we are associated 57.6%. Guys, first of all, in your question, you have to comment on that whether they are associated enterprises or not associated enterprises. So generally, please don't jump into it that you are just calculating ALP. You please apply your logic also. Please apply, keep your, be very, very attentive that you should know, first of all, they should be associated enterprises. And if you will just calculate, see in this type of question, if you will just go away and calculate your ALP, and if you will not comment that whether they are associated or not, you will not get full marks. So first of all, you have to comment that whether they are associated or not. So please write the provision that when one enterprise holds 51% or more, they have given a loan of 51% or more of 51% of what? Of the book value of the assets, then you become an associated enterprises, right? Okay. Now let us start the question. Andes Limited provides software backup support to Andes Incorporation. Okay. So here, India has given services to Malaysian company. So Malaysian company, we have given the services, right? And how much services we have given? A software backup support to Andes Incorporation. Andes Limited India has spent 50,000 man hours during the financial year. Okay. And for how many hours we have worked for them? We have worked for them for 50,000 hours. Good. During this financial year. The cost for Andes is 75 Malaysian dollars per man hour. And how much is the cost? See, how much is our cost? The cost is $75. Although it is Malaysian dollars, I'm writing it dollars only, right? So it is 75 per hour is the cost. Okay. And we have built it at 90.75. See, 90.75, we have actually sold it for per hour. We have charged it at 90.75 per hour. So this 90.75 per hour, which we have charged, is this a correct transaction? No, this might be a controlled transaction. So this might be a controlled transaction. So 90.75 is a influenced price. It is a controlled transaction. So that we don't have to take, but we can start with what? We can start with this our cost, because our cost is this. See, this is our normal cost. So if it is my normal cost, so it is actually a correct price. So $75 per hour is my correct price. Now what I have to see, let's say for example, obviously it's a net transaction margin method. I know it. So what they will give you the profit percentages which other companies are charging in the similar industries, which other companies are charging. So let us see. Gamma Limited in India. So like we have Andes over here. We have Andes India. Similarly, we have another company which is known as Gamma Limited. Okay, let me write it with blue way. This is Gamma Limited India. What they are doing is Gamma Limited India, which has a similar business model. Okay, it is same like ND. So it means that they are actually in the same industry. So which has a similar business model, provides software backup support to Olive Incorporation in Malaysia. Okay. So Gamma, there is a similar transaction between Gamma and Olive. Who are they? They are just other people of the same industry. And they are saying cost and operating profit are as under. Direct cost 600 lakh rupees 600, indirect cost 200 lakh, operating profit 200 lakh. Guys, can you calculate for me what is the profit margin of this industry, of this company? So see, they have mentioned that the direct cost is 600 lakh, indirect cost is 200 lakh, and the operating profit is 200. So can I say that the total cost is 800? So the cost of them is 800 and operating profit is 200. So can I say that these people are earning 25% profit margin? How? Operating simple operating profit upon cost into 100. So can I say that 25% on cost is the profit margin for these people? And these are actually correct price. And can you tell me how much is the profit margin for us? Please tell me what is the profit margin which we are charging, NDs. See, ND's cost is 75. They are selling at 90.75, right? So this is not a correct profit margin. It's the influence profit margin. But still, let me check. So what is the profit here, guys? 90.75 minus, I'm just taking it for 1 hour. So that's okay. We are just calculating the profit. That's okay. So 90.75 minus 75 is how much? Say 15.75. 15.75 upon cost 75 into 100. How much it is? Divided by 75 into 100, 21%. So we are charging 21%, but others are charging 25%. Can you see? Others are charging actually 25%, which is the correct one. This is the correct one. So this is not correct. So what we will take, we will on our cost, we will add 25%. And if there is any functional difference, we will adjust that also. Okay. Calculate arm's length price for the transaction between NDs and NDs Incorporation based on the above data of Gamma Limited using transactional net margin method. Assume $1 is equal to 45. That's okay. So what we will do, so our cost is, what is transaction net margin method? Simple. Start with our cost. Our cost is how much? $75. So our cost is, first I'm calculating it for 1 hour, then I'll multiply it accordingly by the currency rate also and by the number of hours also. So our cost is $75 plus the profit margin of similar companies in the same industries is 25%. We calculated it. So it should be 75 into 25%. This is 18.75. Tell me the total, guys. $93.75 per hour we should charge. We should charge 93.75. So tell me what should be the ALP. This should be the ALP per hour, and the total, in total, how much it would be? See, there are 50,000 hours into 93.75. This much Malaysian dollars we should charge. This is the ALP in Malaysian dollars. Multiply it by 45. So you will get the ALP in rupees. So how much it is? Quite a big number. Into 50,000 into 45. This is 210,937,500. Okay. So this is the ALP. Got it. And guys, how much, what would be the difference? So this is the ALP. You can check it. Yes, this is the ALP. We are getting it over here. This is the ALP. And you can, I believe that you will be able to adjust the difference also. So how much we have charged? We have charged, so how much is the less amount which we have charged? We have charged only 90.75, and the per hour rate should be, ALP is 93.75. So 93.75 minus 90.75. So actually we have charged $3 less. $3 for every transaction we have charged us, and 50,000 hours into 3 into 45. So this is the adjustment which you have to make. Correct? So this is the net margin method. So with this, we have completed with our types of methods which we have. Any other method that you don't have to do. Correct? So any other method you don't have to do it. Give me a moment. Okay. So guys, I think that we can keep it there. If there is more than one ALP, I'll be discussing it in the second part. So let me keep it here. So I was trying that I could finish it up in the 3 hours or so, but I think that it will take little time because I'm discussing questions also with you. So I don't want to rush anywhere. So I'm making a second part of it also. So probably within a day or two, I will be posting the second part also. I want your feedback, that how do you like, how you find the lectures. Please give your comments in the comment section that how you're finding it. What else do you want from me for your May 2026 examinations? What else do you want? So for sure, I'll be completing this transfer pricing, and I'll be taking some other chapters also. What do you want extra? Do you want me to solve more examination related questions? If you want me to solve some case study scenarios also, that also we can do together. So we have sufficient time for our examination. So we'll be able to do a good practice for our exam as well. I need that you should share this video with your friends. Please do share this video. If you have come up till here, do like it also, give a comment also on this. So let us meet in the next part of the transfer pricing. Thank you so much. Bye and take care.